What's the key to unlocking value in the business world?
For over 50 years, CBV Institute has set the standard for excellence in the business valuation profession. The CBV program of studies continues to be regarded as the gold standard in business valuation education, and our members remain highly respected and in demand throughout Canada and the rest of the world. By setting a high bar for our students, our members, and the business valuation community at large, we ensure the ongoing integrity and authority of the CBV designation. The status quo is never good enough, however. Through thought leadership, ongoing curriculum enhancements, and consultation with global regulators and standard setters, we make sure to stay at the forefront of industry developments and trends, keeping our members and students well-positioned for continued leadership in the business valuation profession.
The CBV designation is more than just a professional title. It's a gateway to a wealth of opportunities in the finance and business world. I'd like to elaborate on 5 of the key benefits that members tell us they enjoy as a result of being a CBV. 1. CBVs enjoy extremely diverse career opportunities. CBVs work in a wide range of areas, including corporate finance, transaction advisory, income tax and estate planning, litigation support, financial reporting, and much more. In short, CBVs are needed wherever and whenever an assessment of value is needed to drive a key business decision. 2, because of our high-quality education and professional standards, CBVs are highly sought after and have in-demand expertise. Demand for CBVs and CBV services has never been higher. CBVs are the go-to professionals when businesses or individuals need to understand value, and their skills are crucial in deal-making, litigation, and many other strategic decisions. 3, the CBV designation is respected worldwide, which opens doors to international opportunities, including working on cross-border projects or working overseas. Now, these 3 points taken together means that CBVs have extraordinary job security, which is extremely important in a constantly evolving economic and technological landscape. There will always be demand for valuation expertise. And of course, there are significant financial benefits to being a CBV. Most newly designated CBVs will enjoy a salary bump, and they often command starting salaries approaching or exceeding 6 figures. But most importantly, our members truly find value and have fun in their work, and they love what they do. They're at the forefront of financial market developments. They are leaders in finance and business, and they are constantly learning and adapting to interesting new challenges.
Becoming a CBV is a journey of personal and professional growth. The path to becoming a CBV is relatively straightforward. First, individuals must complete our globally respected program of studies, which delivers practical and relevant business valuation education. After completing the program of studies, the next milestone is the Membership Qualification Exam, or MQE. The MQE is a case-based 4-hour capstone exam, and it assesses your ability to respond to real-world situations that you may encounter as a practicing CBV. Individuals who pass the MQE are eligible to apply for membership. Before applying for membership, there are 2 more requirements. First, because practical experience is crucial in any profession, we require a minimum of 1,500 hours of business valuation or related experience. Because most individuals are working full-time as they work through the program of studies, they have earned their hours by the time they're ready to write the MQE. Secondly, individuals must have a 4-year degree from a recognized post-secondary institution. This means that university students can start the program of studies when they're still in school, but you do need your degree by the time you apply for membership. While a background or degree in finance or business is helpful as you move through the program of studies, it's not a requirement. Business valuation is a multifaceted profession that calls on a variety of skills and aptitudes, with an inquisitive mindset and excellent communication skills being high on the list. The journey to becoming a CBV is a rigorous path, but one that leads to immense opportunity and a rewarding career. Our globally respected CBV program of studies is the cornerstone of the CBV designation. It's designed to deliver practical, relevant business valuation education that places new CBVs at the forefront of business and finance. The program consists of 4 core courses that provide a robust foundation in valuation methodologies and real-world applications. Students also choose 2 out of 4 elective courses, which allows them to specialize in areas such as private investments, litigation support, corporate finance, or valuation for financial reporting, all incredibly important topics. What sets our program apart is its practical, market-driven curriculum. Our content is designed by CBVs for future CBVs, and it undergoes regular updates to reflect current best practices and relevant topics. This means our students are learning directly from industry leaders, and they're gaining knowledge and developing skills that are directly applicable in the workplace. We've built the program to be flexible and accessible. With online, self-paced learning, opportunities to connect with instructors and peers, and courses offered 3 times per year, students can complete the program while working full-time. Plus, all materials and exams are available in both English and French. It's a rigorous program that thoroughly prepares our students to excel as CBVs. Upon completion, they have the in-demand skills and knowledge to succeed in this dynamic, rewarding profession.
As a CBV, you'll develop the unique ability to see what others might miss in the world of business. You'll uncover hidden value, navigate complex challenges, and make a real impact in organizations across a broad spectrum of industries. If you're ready to join a global community of valuation leaders and take your career to new heights, the CBV designation is your path forward. I invite you to embrace this transformative journey and discover the power of seeing beyond the numbers.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
Good morning, everyone, and welcome to BV Challenge 2024, our final day. My name is Kevin Flother, and I'm the Manager of Marketing and Communications at CBV Institute. It's my distinct pleasure to kick off today's event. Just really briefly, a layout of how today looks. We have 6 sets of presentations and then closing remarks and award announcements from 7:30 to 7:45. A very big thank you to all of our sponsors for making today's event possible. It's KPMG and OMERS as title sponsors. Our event sponsors are Davis Martindale and M&P, and our supporter sponsors are Business Valuation Resources and PwC Canada. Thank you immensely for your sponsorship once again. And finally, these are our esteemed judges for day 2. Jennifer Samarco, who is with our title sponsor OMERS, Kinjal Shah, who's with Secretariat, Michael Rudanich, who's with Sun Life Capital Management, and Enoch Zhu, who is with Valuation Solutions. So with that, we're going to admit our first team, and I'll hand it over to them. Good morning, Team 7. Welcome to the final day. We're about to get started here. Whenever you folks are ready, you can share your slide deck. I believe all of our judges are present and ready to go. Anxious to hear your presentation. So with that, I'll hand it off to you folks. Best of luck.
Sounds good. Thanks, Kevin. Okay. Good morning, everyone. My name's Jackson. I'm joined by my colleagues Connor, Tyler, and Natasha, and we're going to give our analysis and recommendation to you guys, the stakeholders of Greenwave Solutions.
First, let's just go through a quick overview of how this presentation will begin. First, we're going to talk on an executive summary, summarizing our final conclusions and analysis. We're then going to break down the fair market calculations of both Greenwave's existing operations and then as the Energy as a Service division's expansion. We're then going to compare and analyze the term sheets and then provide a final recommendation and a Q&A period. We recommend that Greenwave Incorporated accepts the term sheets proposed by William Wise and expands the Energy as a Service division of its business. We calculated an implied fair market value of $62 to $74 million in consolidation of both the Energy as a Service and ESG portion of the business using a capitalized cash flow approach. We then calculated an implied fair market value of $79 to $109 million when using a discounted cash flow approach, factoring William Wise's $30 million on the Energy as a Service expansion. We also applied a rules of thumb as well as precedent transactions to this segment. Finally, we analyzed both term sheets, both in a qualitative and quantitative manner, to come to the same conclusion that partnering with William Wise is the best decision for Greenwave.
We're now going to look at our methodologies that we applied to get our fair market analysis. We use an income-based approach as well as a market-based approach. Within the income-based approach, we used two specific valuation metrics. We used a capitalization of cash flows as well as a discounted of cash flows. For capitalization of cash flows, this is when a firm is at steady state. When I mean steady state is when the revenues, the costs, as well as the cash flows are growing at a consistent amount into perpetuity. What you do is you normalize these cash flows and then you apply a capitalization multiple to get the enterprise value of the firm into perpetuity. We use this for the ESG consulting division as well as the Energy as a Service existing operations. We then used a discounted cash flow. Discounted cash flows are used when firms are growing rapidly and they are not at steady state. What you do is you forecast out their cash flows, and if during forecasting they do enter into steady state, you apply a capitalization multiple similar to the capitalization of cash flows. You then discount all these cash flows back into present day, and you sum them all up to get an enterprise value. We use this for the Energies of a Service expansion. Moving over to the market-based approach, we use a precedent transaction and rule of thumb. For precedent transaction, it is transactions that have occurred within the industry, and the key here is finding comparable firms that were in transactions. These are similar services and similar size. What you do is you take their multiples and you apply them to your own firm to give you an estimation on their value. We use this in the Energy of a Service expansion as well as existing operations. We then looked at the rule of thumb that Jessica and Sarah provided for us as they gave us metrics to see if they were accurate in evaluating the firm. We use this in the Energy as a Service expansion as well as the existing operations. We then looked at the two term sheets and did a quantitative analysis in comparison to the expansion. Now we'll look at the ESG consulting division and the qualitative considerations that we thought of. We looked at Greenwave as a whole and we found a very good advantage and strength as they are cross-selling between their two divisions. In the Energy as a Service division, about 40% of their customers are contributing to the ESG consulting division. They're contributing about $250,000 in annual revenue to that division. One of the weaknesses that we did identify was the integration of EcoVision into the original operations of the ESG consulting division. This has led to higher costs that we will allude to a little bit later. We then identified a threat within this industry as it is highly competitive because large firms are coming into this division due to that steady 4% long-term growth, making it harder for smaller firms like this one. Now, going into how we got our fair market analysis of the ESG consulting division, we did a weighted average approach. Now, a weighted average approach is when you take two different valuation metrics and you take a weighting on both of them to get a more accurate fair market value. We took an 80% weighting of our capitalization of cash flows and a 20% weighting of our EV to revenue approach. This EV to revenue approach was derived from the EcoVision transaction that happened earlier in 2022, and we believe this directly correlated with the value of this firm. Now, the reason we did an 80 to 20% weighting is we do believe that the capitalization of cash flows is more accurate for predicting the future with this firm. If I direct your attention over to the right-hand side, I will break down how we got our WACC. We calculated our WACC at 14%, but we added a 5% premium based on the qualitative factors I alluded to earlier, so we used a WACC of 19% for our calculations. What we did is we took our historical cash flows from 2022 to 2024 and we normalized them. We normalized out the additional marketing costs, the depreciation, the transaction costs, legal fees, the synergies that we do anticipate are going to happen in the future, so we could get that maintainable cash flow amount now, as well as adjusting for Crystal's salary as she does get paid $100,000 more than the industry average, as well as accounting for the earnout qualification she is going to get from the acquisition. As you see in the bottom right-hand corner, we got those normalized cash flows from 2022 to 2024. We then took a simple average of these, which is just an equal distribution, to get a maintainable cash flow amount, which was our pessimistic range. We then took a weighted average of these three amounts with more of a weighting on 2023 and 2024 because those are post-transaction cash flows. And we believe those are going to be more accurate in projecting the cash flows in the future. This gave us our optimistic range. We then applied a capitalization multiple of 6.7 times, which then gave us our capitalized cash flow enterprise values of 22 million to 24 million. We then did that 80 to 20% weighting, and we got our implied equity enterprise values that you see on the board there of 23.8 million to 26.7 million. We then accounted for the current portion of the UCC associated with this division, as well as the cost of the lawsuit that we will have to pay, as well as accounting for the debt, which brought us to an implied equity value of 13.4 million on a pessimistic side and a 16.4 million on the optimistic side.
We valued the energy as a service division of GreenWave's business using a capitalized cash flow approach. First, we normalized the cash flows by taking out depreciation, maintenance, and installation costs. These costs were modified due to the 2022 and 2023 years having labor shortages as well as supply chain issues. This was to ensure that our cash flows were comparable and consistent. We then recognized that this division was in steady state growth in 2024 due to the max amount of contracts being hit, with 5 new contracts and 15 total contracts in that year. Now, if I direct your attention to the top right, you can see that we made both an optimistic and pessimistic outlook. What we did is we calculated a base WACC of 8%, and then we applied a premium of 5 to 7%, depending on the case. These premiums were added based on qualitative factors that will be touched on later in this presentation. We then found our capitalization multiple of 9.52 times, as well as 8 times, and applied those to calculate an enterprise value. We received an enterprise value in the range of $56 million to $47 million. It's also important to note that we recognized a non-capital loss that can be carried over into 2025 as we calculated the taxable amount in 2025. We then recognized this and made a present value calculation to today's dollars and applied this. We then found a total implied equity value after adding our other items listed in the bottom and found an implied equity value of 57 million to 48 million. It's also important to note that we applied the rules of thumb guideline given to us by Sarah and Jessica, which landed at an enterprise value of $52.5 million. As you can see, this fits inside of our range and therefore confirms that our valuation method is strong and confirms this range. Now, if I direct your attention to the bottom left corner, you can see the precedent transactions. We chose these 3 firms because they are in the same business sector as well as have the same customer base. We then took the average of their EV to EBITDA multiple and found a 5.24 multiple. and which, when applied to the last 12 months EBITDA, gave us a valuation of $41 million. Now, we didn't use this valuation, but it was a good check figure for us going forward. Now, our final valuation of the consolidation of the ESG and Energy as a Service division was $62 to $74 million. We also identified an identifiable intangible asset, which we considered redundant and added it back at the end, which was valued at $650,000. Now, we were also tasked with calculating the return on the Series A shares, which would be Earthwise investment, which we calculated an unrealized return of negative 11.9 to 4.9%. Now, if I can direct your attention to the box on the right, the return in excess of the risk-free rate is the alpha returned on that investment, which would be negative 15.6% to 1.2%. As you can see that these percentages fall in range, that is due to the differentiation between the optimistic and pessimistic values given.
Moving into the Energy as a Service expansion, it's important to note that this division makes up a major portion of our fair market value and is going to be integral to the business moving forward. The key opportunity that we identified in the space is actually M&A. Although Greenwave had issues integrating the EcoVision acquisition, the use of insight valuations as an independent third-party advisor could warrant better M&A opportunities and easier integration with in M&A transactions, and we would be happy to advise on those moving forward. The key weakness to the business is really the 3-year contract-based revenues. Given the fact that Greenwave is taking those costs up front, it decreases the front year free cash flows to the firm, and they don't reap those benefits until the latter half of our forecast period, which then decreases their ability to deploy capital internally and grow organically, thereby improving that opportunity to take advantage of external growth opportunities such as M&A. The key external threat, which the company really suffered from in 2023, is supply chain issues as well as labor shortages, which could be volatile and changing year over year. As for the actual valuation of the business, we decided to use, of the expansion, we decided to use a discounted cash flow analysis given the anticipated rapid growth throughout our forecast period. Now, the key input to this DCF analysis was really the customers that we're bringing online. Given the fact that they affect both our revenues and the cost of revenues, the change in increase or decrease and the growth of those customers can have a major effect on our analysis. So we have them forecasted to hit a capacity in 2030 and then grow into perpetuity as of 2032. They reach a capacity in 2031 of 90 customers and grow into perpetuity at 2032. Throughout that forecast period, we have our costs and our revenues growing at 2.5% before that perpetuity period. As for the final valuation of the actual expansion, we've made an optimistic and pessimistic case based on 2 different WACC premiums of 8 to 10%, which then came to an implied enterprise value range, which you can actually see in the bar graph of $108 to $138.1 million. The key deduction we made is actually the $30 million in debt that we're going to use to finance this expansion from William Wise, which came to an implied equity value of $79.4 to $109.5 million. We also use precedent transactions that Connor alluded to in the previous slides, which you can see in the bottom left-hand corner. And we applied our 2029 expected EBITDA figure to a 5.24 times multiple and came to an implied enterprise value of $193 million. Now, we use this more as a sanity check, and given it fell outside of our range, we decided to stick to our DCF analysis for our implied equity value. But then we also applied the rules of thumb that Sarah and Jessica wanted us to see the use of in this expansion. So the rules of thumb valuation came to an enterprise value figure of $315 million. And given it's so far outside of our range, and the rules of thumb rely on the customer contracts coming online, we opted not to use this, and we would advise Sarah and Jessica to stay away from these rules of thumb methodologies if they're going to try and value something in the future, because this industry is growing too fast and we're bringing on too many customer contracts at once.
Now, Sustainable Edge Ventures, which we commonly refer to as SEV, was not chosen in the expansion's fair market value. And actually, as we get into the term sheet comparison, it becomes very evident that this investor is not ideal. Now, venture capitalist funds may take on a predatory nature towards growing companies, and SEV does not fall far from this tree. Now, SEV's terms outline creating a special shares class. These are preferred voting shares with a cumulative dividend of 20% of the face value. Now, at year 3, if these preferred dividends are not consecutively paid, all preferred shares are retractable at face value, and outstanding dividends are due in 2028. This option is not viable for Greenwave, as the energy as a service expansion only experiences significant cash flows in 2029. Now, as a result, Greenwave will have no choice but to declare bankruptcy, and SEV will acquire the first rights of the assets during liquidation of Greenwave. Now, on the other hand, we have William, who's offering a $30 million investment in the form of interest-bearing convertible debt at 8% annually. These terms are long-term viable, and interest payments can be met in the short term via net earnings from the other operating division, at least until 2028. What's worthy to note is that William has significant experience in the energy as a service industry, and this actually gives us an understanding as to why his terms align more with the nature of the industry's contract-based earnings model. Now, proven that William is a valuable partner to Greenwave, Will can convert his debt into 3 million of common shares at maturity, representing 19.5% of shareholder ownership in 2029. Now, let's take a look at how this infringes on the shareholders' agreement. Now, on the very far right, on the very far left, you can see the existing shareholders agreement and SEV in the middle, and on the far left, William Wise. Now, there are 3 significant changes to occur to the existing shareholders agreement. 1 is the governance rights, 2nd is the financial obligations, and 3rd, the right of first refusal. Now, SEV is to appoint 1 director, placing Sarah and Jessica at the same combined voting power of 40% as Earthwise at 40%. Will is to appoint an additional director, placing Sarah, Jessica, and their appointed director at a combined voting power of just over 50%, Greenwise at 33%, and Will at 16.7%. For financial obligations, SEV will require a new class of preferred shares, as previously mentioned, and also, as stated, is that these are non-viable terms based on the expansion's projected cash flows. This infringes on Greenwave's agreement that dividends declared in the fiscal year does not exceed the same year net income. And finally, for the rights of first refusal, Will requires that if the Greenwave founders decide to sell their shares in the next 5 years, he has the first right to buy at fair market value before any other shareholders. And as our final recommendation, we recommend that Greenwave continues with the energy as a service expansion, and we recommend William Wise as a Series B investor. This expansion is a feasible project, and it is projected to create significant shareholder value for its existing shareholders, including Earthwise. Now, William's financial obligations and his qualitative factors align very well with Greenwave. And as Sarah and Jessica mentioned, a potential IPO, this strategy may actually be more feasible in the long term after the expansion's cash flows really kick in. Now, what is the next move? Well, first, Greenwave will need to issue a vote to all current common shareholders on the changes to Greenwave's existing shareholders agreement. This includes the governance rights and the rights of first refusal. This will give William the right to appoint an additional director and the ability to surrender his appointment if his debt conditions are met in 2029. And finally, the right for William to acquire any shares sold by Jessica or Sarah until the end of 2029 at fair market value before any other existing shareholders can purchase on a pro rata basis. And second are the interest payments. Greenwave is to maintain the current terms or renegotiate for deferred interest payments until the project is cash flow positive. And given his experience in this industry, he may actually be more flexible on his terms. And during the initial 4 to 5 years, Greenwave will need to determine a strategy to either retain William as a significant voting power or mutually agree to part ways by repaying the full principal of debt. Now, this includes the impact and implementation to prepare Greenwave for the Series B round.
Thank you, team, and thank you, stakeholders of Greenwave Solutions. We'd like to now open the floor to the questions and answers period.
Hi, I've got a question on the energy as a service business valuation. How did you assess the premiums that you added in your discount rate selection? How did you get to those significant premiums? And then, I guess, secondly, upon reflection of the implied multiples and the precedent transactions, how did that kind of, inform your conclusion as well?
Just to clarify, is that for the expansion or the existing operations?
In the slide that you have up right now,
Okay.
in the optimistic and the pessimistic scenarios.
Jackson, I can answer that one. So for the first portion of the question, our premiums to WACC were based on a few things. We identified a small firm premium, as well as that business model we talked about with no upfront payment was also a significant risk factor to this industry. So those were like the two main risk factors we identified, as well as like some of the other smaller qualitative factors, but those were the two major ones. Now, for precedent transactions, can you repeat that portion of the question, please, just so I understand?
Yeah, no, thanks for asking for clarification. So what I'm interested in understanding is when you looked at your implied multiple from your analysis, and then when you compared it to the precedent transaction, what were some of the initial observations? And then why did you ultimately decide not to make any adjustment to your valuation?
Awesome. Thank you for your clarification. Well, our initial observations was initially that the value came out slightly lower, and due to us using the rules of thumb method as well as our capitalized cash flows, we felt that they better represented the cash flows that we've seen from the firm. And we felt that it was a more equitable and fair approach to valuing this company to consider those two methods over top of this EV to EBITDA method. We also found that the comparable companies, while they were the best comparables, they weren't direct comparables. So we felt that that was a factor that weighed us away from weighting that EV to EBITDA multiple.
And lastly, to follow up my question, can you share a little bit more on some of your observations on the comparable companies and perhaps why you felt that they were not as comparable?
Just due to like small differences in each comparable company, they all had either because our main company operates in the smart lighting sector and has commercial and industrial customers. All of our comparables either had one or the other. They didn't have both the same, I guess, customer base. And there we found it didn't exactly hit the industry, as well as I believe Green Beam has intentions to shift to the retail lighting sector. So their focus was slightly off of the industry and the sector that GreenWave ultimately wants to compete in.
Thank you.
There. Thanks for the presentation. I have a couple of questions on, I guess we'll go to page 6 first. Previous page. You have done an 80-20% weighting on the two different approaches. I was just curious as to how different these two valuations were and what you believe are the causes for the differences.
I'll take this one. So with the capitalized cash flows, we were looking at the historical cash flows of the company specifically. With the multiple, we were basing it off of that EcoVision acquisition. We believe that that acquisition was directly related to the value of the firm, but since it's more of an estimation of the value of the firm and it's not directly related to the direct cash flows that they're producing currently, we believe that's why we got the 80-20 split. We put more of the weighting onto the cash flows, but we still felt like the multiple was relevant in the analysis, so we still wanted to account for it in that 20%.
Was there a large valuation difference between the two? If you just used 100% of one or 100% of the other as a value?
So the exact values that we got with the pessimistic and optimistic from the capitalized cash flows was between 22 million and 24 million. And then when we used the multiple, it was between 30 million and 34 million. So because of that, we're like, it's a little bit out of where we think the company is in comparison to what we got with the capitalized cash flows. So that's why we lean more towards that 80% rule. But like I said, we still felt it was relevant, so we did want to add that 20% ruling to it.
Thank you. And I'll jump to page, I think it's 12. And I guess it was discussed here that I would love to hear some elaboration on why you think the company could go bankrupt. And two, what could the company do to sort of avoid that situation? If in fact I guess the shares were retracted at 30 million.
Well, I'll answer that question. Thank you, Michael. Well, given the, as we described in the qualitative factors, the company's weakness is that 3-year contract based revenues, and SEB in particular, their terms specifically outline that at year 3 they want all of their cumulative dividends paid in full, and if not, it will be taxable. Now, given the well, if we were to compare at least to William, there's still enough cash flow to actually make these interest payments from their ESG division, at least until 2028. And now in SEB's case, with the 18 and 30 million costs, this will severely impact the company to the point where they're not able to pay these financial obligations. And given with what would proceed next, with our main assumption is that SEB is intentionally trying to aim towards you know, they essentially want this company, and this is more of that predatory approach that they're aiming for. And we do not see a viable solution where Jessica and Sarah and founders and Earthwise can all come out of this situation happy, at least, where SEB doesn't take full control or at least acquire the first rights of their assets. So that is why we really believe that William Wise is more of the right investor for this Series B round.
So just to summarize a little bit, is you're concerned that this could have a huge impact on the company at the time, and this is one of the reasons to avoid this particular term sheet.
Certainly, yes.
Okay, thank you.
I can go next. Good to see you again. Very polished presentation as always. But the stakes are higher this time, so the question might get tougher. If we can jump to page 8 of your presentation, I'm looking at, if I were Earthwise, I'm looking at my annualized return, which is -15 alpha, -15.6 to 1.2% over the past 3 years. So I want you to sort of comment on what kind of, given the stake that Earthwise have, which is 35% in our common shares, what influence they can have, and if this lack of return is a concern for them, would it block our investment with the expansion? And how would you address that if that's the case?
Yeah, I could answer that. First of all, of course, an unrealized loss would be a concern to the company, especially when we factor in how it's in excess of the risk-free rate. However, the best way for them to recoup some of those losses would actually be to move forward with the expansion, and they would certainly have a say in how we approach this. Additionally, the use of William Wise and bringing on that additional party who has tons of industry experience and could very much grow the brand reputation could lead to a better exit for Greenwise down the road, where they could potentially even have a better capability of initial public offering.
Right. So you think like because they are minority shareholder of 35%, they wouldn't be able to block our change in shareholder agreements or any resolution that we require for expansion. And it's in the best interest of the Greenwise to tag along with this investment. Am I correct?
Exactly. Otherwise, if we decided to proceed with some sort of sale, they could potentially realize a loss. Now, keep in mind, this is still a range,
Yes.
and we could even see a premium in an acquisition scenario or an initial public offering, and they could realize a gain. However, in our base scenarios, it's most likely that they would realize a loss just on the Series A investment.
Right. My next question relates to page 14. So I do like the final recommendation where you summarize all the key factors and a chart of the free cash flow that we're expecting. But as we all know, the valuation is as good as our projections. And in this case, what I see from the biggest jump is 2028 to 2029. And that's about 4 years out. And at that time, US will have a new president. And we wouldn't know what would happen in 25 years out. So I just want you to give me an overview of what's the change between 2028 and 2029, and is it feasible for us to go from about 4 million free cash flow to the next year of 25 to 28 million of free cash flow in one given year?
Yes. See, the biggest point there is actually in bringing on those customer revenues. I am pulling up this slide here.
Mm-hmm.
As we bring on more revenues, we have a lot of torque to bring on those customer contracts, and bringing on so many at once in the expansion is what's going to really grow our free cash flows for the firm. Additionally, given those 3-year contract-based revenues, those free cash flows don't kick in until about that 2028, 2029, 2030 period.
Right. So just looking at the slides, so you have the gross profit, you have the EBIT, and then you deducted the provision for income taxes and the loss carry forward, presumably. And then you got free cash flow. Just wondering, have you considered any additional required working capital that would be required when you have an increasing revenue in this case?
Yes, in calculating our free cash flow to the firm, we did calculate changes in working capital. Primarily, however, the working capital in this business is mostly focused on the ESG consulting division. In this projection, however, we did factor in some changes, and it was mostly factored in when we forecasted our free cash flows to the firm growing.
All right. Oh, thank you. That's all my questions.
Thanks, Enoch. Great presentation, team. I have a couple of questions. I know we're running short on time. I'll make it quick. The first question I have is going to, slide 12. And it's more of a, I want to hear your thoughts, knowing that, Greenwave's looking to eventually go for an IPO, and Sustainable Edge Ventures does have experience in that area. So what weightage, or, how did you factor in that analysis while making your final recommendation?
I could answer that. First of all, given the Sustainable Edge Ventures special share class, we felt that when going into the public markets, this could actually be frowned upon, as opposed if we went into the public markets closer to the 2030 range. We could just do that with common stock, as well as with the addition of William Wise, who could be a chairman of some sorts, or could put in a great brand reputation or greatly increase our brand reputation when seeking public investment. Furthermore, as Insight Valuations is now getting involved with Greenwave, we feel that having a business that's going to have positive cash flows in 2028, 2029, and there beyond, we're going to have a lot more time to prepare for that initial public offering versus if we had to do some sort of restructuring scenario or pull the company out of bankruptcy because they use sustainable edge ventures. And then on top of that, they have this significant special share class going into the public markets to raise capital.
Okay. All right. Thanks. That was my question. I don't have any more.
Great. Thank you very much, team number 7, for this awesome presentation. Judges, you'll be moved into a breakout room momentarily to begin your deliberation if you're not already there. And for the rest of us, we'll just be waiting until the next presentation. So again, thank you, team 7. Great job. And you guys can leave the meeting.
Thank you.
Kevin.
Thank you.
She's on it. You're good?
For over 50 years, CBV Institute has set the standard for excellence in the business valuation profession. The CBV program of studies continues to be regarded as the gold standard in business valuation education, and our members remain highly respected and in demand throughout Canada and the rest of the world. By setting a high bar for our students, our members, and the business valuation community at large, we ensure the ongoing integrity and authority of the CBV designation. The status quo is never good enough, however. Through thought leadership, ongoing curriculum enhancements, and consultation with global regulators and standard setters, we make sure to stay at the forefront of industry developments and trends, keeping our members and students well positioned for continued leadership in the business valuation profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
The CBV designation is more than just a professional title. It's a gateway to a wealth of opportunities in the finance and business worlds. I'd like to elaborate on 5 of the key benefits that members tell us they enjoy as a result of being a CBV. 1. CBVs enjoy extremely diverse career opportunities. CBVs work in a wide range of areas, including corporate finance, transaction advisory, income tax and estate planning, litigation support, financial reporting, and much more. In short, CBVs are needed wherever and whenever an assessment of value is needed to drive a key business decision. 2, because of our high-quality education and professional standards, CBVs are highly sought after and have in-demand expertise. Demand for CBVs and CBV services has never been higher. CBVs are the go-to professionals when businesses or individuals need to understand value, and their skills are crucial in deal-making, litigation, and many other strategic decisions. 3, the CBV designation is respected worldwide, which opens doors to international opportunities, including working on cross-border projects or working overseas. Now, these 3 points taken together means that CBVs have extraordinary job security, which is extremely important in a constantly evolving economic and technological landscape. There will always be demand for valuation expertise. And of course, there are significant financial benefits to being a CBV. Most newly designated CBVs will enjoy a salary bump, and they often command starting salaries approaching or exceeding six figures. But most importantly, our members truly find value and have fun in their work, and they love what they do. They're at the forefront of financial market developments. They are leaders in finance and business, and they are constantly learning and adapting to interesting new challenges. As a CBV, you'll develop the unique ability to see what others might miss in the world of business. You'll uncover hidden value, navigate complex challenges, and make a real impact in organizations across a broad spectrum of industries. If you're ready to join a global community of valuation leaders and take your career to new heights, the CBV designation is your path forward. I invite you to embrace this transformative journey and discover the power of seeing beyond the numbers.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS?
What's the key to unlocking value in the business world?
Our globally respected CBV program of studies is the cornerstone of the CBV designation. It's designed to deliver practical, relevant business valuation education that places new CBVs at the forefront of business and finance. The program consists of 4 core courses that provide a robust foundation in valuation methodologies and real-world applications. Students also choose 2 out of 4 elective courses, which allows them to specialize in areas such as private investments, litigation support, corporate finance, or valuation for financial reporting, all incredibly important topics. What sets our program apart is its practical, market-driven curriculum. Our content is designed by CBVs for future CBVs, and it undergoes regular updates to reflect current best practices and relevant topics. This means our students are learning directly from industry leaders, and they're gaining knowledge and developing skills that are directly applicable in the workplace. We've built the program to be flexible and accessible. With online, self-paced learning, opportunities to connect with instructors and peers, and courses offered 3 times per year, students can complete the program while working full-time. Plus, all materials and exams are available in both English and French. It's a rigorous program that thoroughly prepares our students to excel as CBVs. Upon completion, they have the in-demand skills and knowledge to succeed in this dynamic, rewarding profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
Becoming a CBV is a journey of personal and professional growth. The path to becoming a CBV is relatively straightforward. First, individuals must complete our globally respected program of studies, which delivers practical and relevant business valuation education. After completing the program of studies, The next milestone is the Membership Qualification Exam, or MQE. The MQE is a case-based 4-hour capstone exam, and it assesses your ability to respond to real-world situations that you may encounter as a practicing CBV. Individuals who pass the MQE are eligible to apply for membership. Before applying for membership, there are 2 more requirements. First, because practical experience is crucial in any profession, we require a minimum of 1,500 hours of business valuation or related experience. Because most individuals are working full-time as they work through the program of studies, they have earned their hours by the time they're ready to write the MQE. Secondly, individuals must have a 4-year degree from a recognized post-secondary institution. This means that university students can start the program of studies when they're still in school, but you do need your degree by the time you apply for membership. While a background or degree in finance or business is helpful as you move through the program of studies, it's not a requirement. Business valuation is a multifaceted profession that calls on a variety of skills and aptitudes, with an inquisitive mindset and excellent communication skills being high on the list. The journey to becoming a CBV is a rigorous path, but one that leads to immense opportunity and a rewarding career.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
For over 50 years, CBV Institute has set the standard for excellence in the business valuation profession. The CBV program of studies continues to be regarded as the gold standard in business valuation education, and our members remain highly respected and in demand throughout Canada and the rest of the world. By setting a high bar for our students, our members, and the business valuation community at large, we ensure the ongoing integrity and authority of the CBV designation. The status quo is never good enough, however. Through thought leadership, ongoing curriculum enhancements, and consultation with global regulators and standard setters, we make sure to stay at the forefront of industry developments and trends, keeping our members and students well positioned for continued leadership in the business valuation profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
The CBV designation is more than just a professional title. It's a gateway to a wealth of opportunities in the finance and business world. I'd like to elaborate on 5 of the key benefits that members tell us they enjoy as a result of being a CBV. 1. CBVs enjoy extremely diverse career opportunities. CBVs work in a wide range of areas, including corporate finance, transaction advisory, income tax and estate planning, litigation support, financial reporting, and much more. In short, CBVs are needed wherever and whenever an assessment of value is needed to drive a key business decision. 2, because of our high-quality education and professional standards, CBVs are highly sought after and have in-demand expertise. Demand for CBVs and CBV services has never been higher. CBVs are the go-to professionals when businesses or individuals need to understand value, and their skills are crucial in deal-making, litigation, and many other strategic decisions. 3, the CBV designation is respected worldwide, which opens doors to international opportunities, including working on cross-border projects or working overseas. Now, these 3 points taken together means that CBVs have extraordinary job security, which is extremely important in a constantly evolving economic and technological landscape. There will always be demand for valuation expertise. And of course, there are significant financial benefits to being a CBV. Most newly designated CBVs will enjoy a salary bump, and they often command starting salaries approaching or exceeding 6 figures. But most importantly, our members truly find value and have fun in their work, and they love what they do. They're at the forefront of financial market developments. They are leaders in finance and business, and they are constantly learning and adapting to interesting new challenges. As a CBV, you'll develop the unique ability to see what others might miss in the world of business. You'll uncover hidden value, navigate complex challenges, and make a real impact in organizations across a broad spectrum of industries. If you're ready to join a global community of valuation leaders and take your career to new heights, the CBV designation is your path forward. I invite you to embrace this transformative journey and discover the power of seeing beyond the numbers.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
What if the things that captivate you, the passions that drive you, everything that makes you, you could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What's the key to unlocking value in the business world?
Our globally respected CBV program of studies is the cornerstone of the CBV designation. It's designed to deliver practical, relevant business valuation education that places new CBVs at the forefront of business and finance. The program consists of 4 core courses that provide a robust foundation in valuation methodologies and real-world applications. Students also choose 2 out of 4 elective courses, which allows them to specialize in areas such as private investments, litigation support, corporate finance, or valuation for financial reporting, all incredibly important topics. What sets our program apart is its practical, market-driven curriculum. Our content is designed by CBVs for future CBVs, and it undergoes regular updates to reflect current best practices and relevant topics. This means our students are learning directly from industry leaders, and they're gaining knowledge and developing skills that are directly applicable in the workplace. We've built the program to be flexible and accessible. With online, self-paced learning, opportunities to connect with instructors and peers, and courses offered 3 times per year, students can complete the program while working full-time. Plus, all materials and exams are available in both English and French. It's a rigorous program that thoroughly prepares our students to excel as CBVs. Upon completion, they have the in-demand skills and knowledge to succeed in this dynamic, rewarding profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
Becoming a CBV is a journey of personal and professional growth. The path to becoming a CBV is relatively straightforward. First, individuals must complete our globally respected program of studies, which delivers practical and relevant business valuation education. After completing the program of studies, the next milestone is the Membership Qualification Exam, or MQE. The MQE is a case-based 4-hour capstone exam, and it assesses your ability to respond to real-world situations that you may encounter as a practicing CBV. Individuals who pass the MQE are eligible to apply for membership. Before applying for membership, there are 2 more requirements. First, because practical experience is crucial in any profession, we require a minimum of 1,500 hours of business valuation or related experience. Because most individuals are working full-time as they work through the program of studies, they have earned their hours by the time they're ready to write the MQE. Secondly, individuals must have a 4-year degree from a recognized post-secondary institution. This means that university students can start the program of studies when they're still in school, but you do need your degree by the time you apply for membership. While a background or degree in finance or business is helpful as you move through the program of studies, it's not a requirement. Business valuation is a multifaceted profession that calls on a variety of skills and aptitudes, with an inquisitive mindset and excellent communication skills being high on the list. The journey to becoming a CBV is a rigorous path, but one that leads to immense opportunity and a rewarding career.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
Good afternoon or morning, everyone, depending on where you're dialing in from. Team number 9 should be joining us momentarily. I have 3 of 4, 4 of 4 are here. Great. Welcome to day 2 of CBV Institute's BV Challenge, the finals. Congrats on making it this far, folks. I will hand it over to you to share your screen and start whenever you're ready.
All righty. Good morning, everyone. Hope you all are having a pleasant day. My name is Sabrina Chu.
I'm Caitlin.
I'm Cedric.
I'm Muskan.
And today we will present to you our valuation analysis for Greenwave Solutions, Inc. and provide a comprehensive assessment for their Series B funding round. So we'll begin with an overview of our tasks and conclusions, followed by the company timeline and its current operational landscape. Next, we will dive into a valuation of Greenwave's existing operations and its proposed EAS expansion. After, we will compare the 2 Series B term sheets and conclude with our strategic recommendation. Before analyzing the 2 term sheets, we first need to establish the FMV of Greenwave's current operations and then compare this with the Series A valuation. Next, we will assess the financial feasibility of the proposed EAS expansion to determine if it justifies the $30 million capital raise. Following that, we will analyze the 2 Series B term sheets and examine their impact on shareholder dilution and implications for the shareholders' agreement. And finally, we will integrate all of these insights to present a recommendation that aligns with Greenwave's objectives. And after performing our valuation analysis, we arrived at several key conclusions. The first being that Greenwave's current operations are at $118.84 million, which shows a significant increase of 66.32% from their Series A valuation. Secondly, the proposed EAS expansion has a projected FMV of $89.1 million, reflecting nearly threefold growth potential. Thirdly, our analysis of the 2 term sheets revealed that Term 1 poses insolvency risk, while Term 2 offers a more stable valuation range. And considering both term sheets' impact on valuation, net income, and shareholder agreement, we determined William Wise as our choice for the Series B round investor.
Before we jump into the analysis, we would like to walk through with you about the Greenwave's timeline and scope in the future. Greenwave was founded in 2018 as a private Canadian company with only ESG consulting division at that time, and expecting to have a long-term growth rate of 4%. In December 2021, Greenwave was able to raise $25 million from its Series A funding round to launch EES division. An EES division offered companies to transition to a smart lighting system with zero installation fee and with an annual subscription fee of 2.5% increase each year. In September 2022, Greenwave acquired EcoVision, and then Crystal, as CEO of EcoVision at that time, became the head of Greenwave's ESG consulting division with $350,000 annual salary. In 2023, Greenwave has encountered a lawsuit from its ESG consulting clients with significant legal fees and lawsuit damage. Greenwave currently is looking for $30 million from its Series B funding round to support the growth of ES division. It also plans to take Greenwave to public in the long term and to improve the liquidity for existing shareholders. Coming to this page for calculating the earning multiples for its fair market value existing operations, since we have 2 different divisions, we have 2 different earning multiples. And for ESG consulting division, we have 20% cost of equity, 6% after-tax cost of debt, and 75% debt to equity ratio. We're able to have a weighted average cost of capital of 14%. And considering its growth rate of ESG divisions of 4%, we're able to have a capitalization rate of 10% and a 10 times earning multiple. For ES division, we have 22% cost of equity, 8% after-tax cost of debt, 100% debt to equity ratio. We're able to have a weighted average cost of capital of 15%. And since this expectation on increasing the subscription fee of 2.5% each year, we're able to conclude the growth rate on ES division of 2.5% and having capitalization rate of 12.5% and have an 8 times earning multiple. As you can see over here, ES division has a slightly higher WACC than the ESG consulting Consulting division due to its later launch and growth-oriented nature. So it brings higher risk compared to the established ESG operations. And assigning to a higher WACC to ES reflects the increased risk and uncertainty of scaling. Using a risk-adjusted formula for WACC as a discount rate, we achieve a comparable value of 15%.
Now let's move on to analyzing the fair market value of the existing operations for GreenWave. This evaluation does not include the ES expansion plan. We use the capitalized earning approach to evaluate the existing operations, and the main reasons we use this approach is: one, we had historical information about the past 3 years' cash flows available to us. Two, we expect the cash flows to grow at a slow and a steady pace. And three, it allowed us to compare the different divisions, mainly the ESG consulting and the EAS division for the company at the same time. To start off, we began by calculating EBIT, the earnings before interest and taxes, and made some normalization adjustments to account for the cost that we do not expect the company to incur moving forward. Some of the normalization adjustments we made included additional costs of training in 2023-2024 and extra marketing expenditures in 2024. These two adjustments happened mainly because of employee turnover in the year 2023 after GreenWave acquired EcoVision and the employees left the company. Next, we accounted for Crystal's wage. Crystal is the head of the ESG consulting division and is being currently paid $350,000, but the market wage for the same role should have been $250,000. We also accounted for additional installation and maintenance costs that the company incurred in the years 2023-2024 due to a supply chain issue faced by the company. Moving forward, we accounted for some non-recurring items like depreciation, legal fees, and the transaction costs associated with the acquisition. Lastly, we accounted for the lawsuit damages incurred by the company. As talked about previously, an employee for the ESG consulting division made a mistake while calculating the interest discount for one of their clients, making the company liable to pay all of the missed payments. We found that the company had to pay mainly three kinds of expenses: one, the audit and legal costs for the bank; two, the missed interest by the client; and three, the penalty on the missed interest. Moving forward, we reduced the income tax at 26.5%, as well as the capital expenditures, and added the tax shield back to get a net income or after-tax income. Then we capitalized this net income to find the enterprise value for all 3 years. Adding back the redundant assets and reducing debts, we were able to come to the FMV, or the equity value, for all 3 years. Considering that the company is expected to grow at a slow and steady pace moving forward, we decided to use the information for the past 12 months or the last year as the fair market value for the company, making it $118.84 million.
Compared to CRC run and fair market of the existing operations, from previous slide, we're able to have $118.84 million as a fair market value, as this value derived from the operation developed since the Series A round. In Series A round, Earthwise was able to invest on GreenWave for $25 million, exchanged for 35% ownership of GreenWave. For this one, we consider to use post-money valuation. Having investment amount over the ownership percentage, we're able to have a $71.43 million. Overall, the valuation increased about $47.37 million and also 66.32% increase. This 66.32% increase in valuation suggests a significant growth in GreenWave's operational value. It also shows effective capital use from its Series A funding round and operational success across both divisions. Especially in the ESG consulting division, it's able to generate stable revenue stream and growth. This comparison provides us a solid foundation and reference for GreenWave as it considers a Series B funding round, and is showing to our investor that the company has added substantial value since the Series A investment.
Now, moving on to the FMV of GreenWave's proposed EAS expansion, we used a discounted cash flow method to calculate the equity value. We first began by forecasting cash flows for the next 5 years by projecting the number of annual installations, total revenue, and associated costs. Our revenue model accounts for the annual subscription fees, which increases by 2.5% each year, while our cost projections include the installation and maintenance fees and operating expenses. From these forecasts, we derived earnings before interest and taxes, made normalization adjustments, and added back depreciation. Then we subtracted income tax at 26.5% to get net income and deducted CapEx to determine free cash flows. Using the given cost of equity, after-tax cost of debt, and equity-debt ratio, we calculate the weighted average cost of capital at 15%. We then used the perpetuity growth model with a growth rate of 2.5 to estimate the terminal value, and both the terminal value and the projected cash flows were discounted back to the present using the WACC, which gave us our discounted annualized cash flow value. And adding that to our discounted terminal value, we obtained our discounted cash flow value and deducted the tax shield to get our enterprise value. And since there were no debt or redundant assets, the FMV resulted at 89.1 million. And the reason why we chose the DCF approach was because the EAS division's future cash flows are both predictable and supported by a stable subscription-based revenue model. It also takes into account the uncertainty of cash flows and provides us with the flexibility to adjust assumptions in response to changes in cash flow expectations. And with that being said, we do expect cash flows to stabilize and for the division to be positioned for long-term growth, which makes a DCF the most appropriate method for capturing this value. Now, to assess whether the EAS expansion's valuation supports Greenwave's anticipated capital raise, as our analysis determined, the FMV of the proposed expansion is 89.1 million, and given Greenwave's plan to raise 30 million, the potential return is nearly 3 times that of the initial investment, or a multiple of 2.97. And this strong return ratio highlights the high value potential of the expansion, and we can confirm that the FMV of the EAS expansion justifies the 30 million capital raise. It is not only feasible, but also financially attractive and a strategic investment for them to experience long-term growth, because with the additional funding, Greenwave can scale up the EAS division and increase the number of annual installations and expand their customer base, which will ultimately drive future revenues and their market presence.
Now take a look at the first term sheet offered by the Sustainable Edge Ventures Incorporation, SEV. SEV is a venture capitalist fund that invests in energy and technology companies at the Series A and Series B stage. They're currently offering Greenwave $30 million for 25% of voting rights, as well as cumulative dividends of 20% of the face value paid annually. Something important to note here is that if the dividends aren't paid fully for 3 consecutive years, the shares become immediately retractable at face value, plus the unpaid dividends. SEV can also replace Sarah and Jessica, the current founders of Greenwave's joint appointee, with one of SEV's appointee, and has the ability to buy back voting preferred shares at $6.5 each should their voting interest fall below 20%. Another important consideration is that while SEV-supported companies have gone public and remain operational, SEV currently has no investments in ESG consulting or EAS companies. We used a forecasted cash flow analysis to determine the SEV's impact on Greenwave's net income. We started by using the forecasted information to project the cash flows for the next 5 years and made normalization adjustments to calculate EBITDA. Then we subtracted income tax at 26.5% as well as the capital expenditure to find the pre-dividend free cash flows. If you'll see on the screen above the row highlighted in red, the pre-dividend free cash flows are negative for the first 3 years and only become positive in the 4th year. However, with 20% cumulative dividends paid annually, which is basically $6 million paid annually, the post-dividend free cash flows become negative for the first 4 years and only become positive in the 5th year. This cumulative nature of SEV's dividend means that Greenwave will be under immense pressure to pay them back, essentially damaging equity. Theoretically speaking, the company could cover the first 2 negative cash flows using the existing redundant assets as well as the $30 million in equity. However, then the firm would require back pay for the next 2 years of dividend, otherwise risk insolvency in 2029, making the total cost $48 million. That is $30 million for the retractable equity as well as $18 million for the missed dividends. This retractable cumulative shares effectively mimic the principal interest, essentially a liability for the company. Now let's take a look at SEV's impact on valuation. Using the post-dividend free cash flows that we calculated in the last slide, we used the WACC to bring them back to the present value and calculate the enterprise value for the company. Adding back the redundant assets of $30 million, and note that we find the equity value to be $98.158 million. To give value, to make sure that our analysis was actually correct, we also calculated the payout ratio for all 5 years for the company, and we find that the Greenwave will have to sustain negative payout ratios as high as 108% for the first 3 years, which means that the company will be paying out more money than it'll be earning. And unless Greenwave wishes to defer cumulative dividends, which is essentially decreasing liquidity and increasing risks, it will have to consider external debt or another funding series, which is probably not a good idea for the company at this stage. Lastly, let's take a look at how the shareholder agreement considerations affect the company. Currently, there are 5 members on the board. With the new structure, there will still be 5 members on the board, but the SEV appointee will be replacing Jessica and Sarah's joint appointee, effectively decreasing their voting power from 60% to 40% in the new structure. This means that Sarah and Jessica will no longer have a majority say in how the company operates moving forward. It is also important to note that before, Jessica and Sarah had 50%, approximately 50% shares in the company, but moving forward, they shall only hold 36% shares in the company, diluting their shares.
All right, on to term sheet 2. So term sheet 2 is a proposed investment by William Wise, and he's a tech entrepreneur, but also an angel investor. And that's important for the strategic considerations later. He previously served on a board of an energy as a service company, which was focused on HVAC systems. And he also strongly believes in the long-term potential of energy as a service companies. The initial investment amount would be the same as SEV with $30 million. But instead of being equity financing, it would be debt financing, at least on paper, in the form of a convertible debt. So this corporate bond would have 8% annual interest, which had to be paid at the end of each year, and then it matures after 5 years. And at that point, William has the option to either be in the money, or he can exchange the principal for equity in the form of 3 million common voting shares, or he has the ability to demand the full principal back, and that's going to impact the valuation later. So in terms of the new governance rights, while William is an investor in the company, either through the bond maturation period, or if he decides to be in the money and exchange his principal for equity, he has the ability to appoint a new director. And that's, instead of replacing the previous joint appointment, it's a new appointment, but it's going to act quite similarly. And then in terms of the rights of first refusal, rather than the shares being offered up to the other shareholders at a pro rata basis, if Jessica or Sarah sell, William will actually get the first right to buy them instead of everybody else. So now let's look at how this impacts net income. So effectively, if we start off by looking at our EBITDA again, we can subtract taxes at 26.5%, standard for Ontario, and then we get our net operating profit after taxes. And now we have to consider what our interest is on this corporate bond. So effectively, 8% interest to be paid on the principal each year without a compounding interest because it's paid in full, it would be $2.4 million. So we can add subtract a constant $2.4 million from each of our net operating profit after taxes for all the projected earnings, and then subtract capital expenditures as well, which will give us our new net income values. And we can see that unlike SEV, it's not negative for 4 years, but only 3 years. And we can see that it actually becomes quite positive by the 4th and 5th years, and even reaching $24 million by 2029. So if we consider over the entire bond maturation period, that actually means that we're making over $5 million in net income. And if we add that to our existing redundant assets at the time of the expansion in 2024, we would actually have about $11 million over the bond principal at maturity. So they would be able to meet the bond principal, and even if William decides to switch to equity, they're also completely fine. So effectively, they can meet all their long-term and short-term obligations without any liquidity issues like with SEV. So now let's consider how this impacts their valuation. So for the valuation, we're going to take a similar DCF model that Sabrina used from before, except now we're going to alter it with the new changes in net working capital. And because the interest has to be paid per annum, and it's a short-term thing, that means that the net working capital is going to have to decrease by that same 8% of the $30 million principal of about $2.4 million a year. So now if you see at the top, our net operating profit after taxes is going to be subtracted by capital expenditures and the new change in net working capital to give us our new free cash flows, which are going to be slightly different from previously. And that means that we're going to find our enterprise value and our terminal value first by projecting the 2029 free cash flow with our perpetuity growth method, and then we're going to discount it back using our weighted average cost of capital, and it's going to give us a lower enterprise value than we previously would have had, which is about $80 million, as you can see on the screenshot on the right here. So then after that, we now have to consider the convertibility of the bond. So if William decides to be in the money, we're actually going to add $30 million to that enterprise value to get our equity value, because instead of debt, it would actually be in the form of equity, and that would also cause share dilution, but I'll mention that in a second. However, if he decides to demand the whole principal back, the equity value would actually drop from the enterprise value by 30 million. So we have an equity value of either 50 million, just about, or 110 million, depending on whether he decides to demand the principal or exchange for equity, respectively. And in both cases, the implied share price would fall. However, it would actually fall less if he decides to gain equity. So that's why that would be the best case scenario. And now I'm going to talk about how this actually impacts the governance structure. So in terms of the board, previously Sarah and Jessica held 60%, but now they'll only hold exactly half of the board with the new appointment by William Wise. So in this case, they're going to actually have to collaborate with other people to be able to run many of the company's managerial processes. And in terms of the shareholder structure, we're actually going to drop from about 48% of common shares held by Jessica and Sarah to only about 38.6. So this is also quite a drop, and this demonstrates the share dilution that we were experiencing. So now I'm going to pass this over to Caitlin so she can go over the final overview and comparison.
Right. So after listening to analysis of both term sheets, we're able to provide the recommendations and couple strategic factors for its considerations. For both term sheets, we're able to provide pros and cons. Now let's look at term sheet number 1, SEV. Here comes to 2 pros. One is SEV offers non-debt financing and provide valuable in-house advice, and which could support companies' growth. However, SEV's involvement could provide certain risk as the insolvency concern due to high dividends and its lax experience in investing EES firms before, and SEV has the potential to acquire discount shares if more shares are issued, which could impact the ownership structure. And SEV appoints directors is based on its ownership percentage, which could lead into permanent loss of voting control. Looking at term sheet number 2, William Wise, William is a qualified angel investor who believes in EES, which aligns quite well with the Greenwave's mission, and it offers debt financing prevents share dilution, and his bond convertibility will help companies to improve the liquidity and versatility. And more importantly, its loss of board controls and a voting share may only be temporary. On the downside, Williams' investment will require a company to resign some of its control of the board directors and common voting shares, and also if he converts, and William will receive a share at a high discount rate. Overall, we're able to conclude that Greenwave has a unique position in a high-growth ESG industry with significant lucrative potential, and we support accepting William Wise Series B funding to proposal to help fund Greenwave's ambitious EES expansion plan. The EES expansion will benefit shareholder interest in the long run through high projected earnings, and Williams' offer will minimize governance and liquidity concerns with added versatility of convertible debt. We believe that given Greenwave's current and future valuations, accepting Williams' terms will be feasible and beneficial if they do diligence with regards to our consultation. So thank you so much for listening to our presentation. We're opening to answer any questions you may have.
Thank you, everyone. Pretty great presentation. I had one question. So in your evaluation of the divisions and pre-expansion and post-expansion, did you consider any secondary approaches or rules of thumb?
We used the capitalized earning approach specifically for this method because we thought that we already have the information for the past 3 years. So this is the real data. We're not projecting any data. And it's usually okay to use this method if you expect the company to grow at a stable growth rate, which we think will be the case. We didn't really calculate a range because the company took over Ecovision in 2023, and there were some turbulences which can obviously be seen in the cash flows in the company, because we see 25 million negative cash flows and then 55 million in the second year and finally 118 million the last year. Considering that there were some turbulences, there wasn't really an option for us to take into consideration a range, so we decided on just using the last year as the final answer, and that's why we use the capitalized earning approach here.
Okay. My question is more towards corroborating this value conclusion using any other method, any other secondary method like market multiples or any other rules of thumb that might have been provided. Is that something that the team considered, and was there a rationale, behind not analyzing that angle?
We didn't actually do an analysis. We didn't include any slides, but looking at the appendix where we had information about the other companies in the, we didn't have an appendix on this slide, unfortunately, but we did a qualitative analysis and looked at the value of the company currently. Considering the other companies in the market, given in the case study, we were able to see that the selected multiples were in the same range about the other companies. So we thought, considering that our calculations are reasonable, we are adding back all the different, we are adding and taking into consideration different assets, different debts. We thought that this approach will be sufficient, and we didn't really do any other approach.
Okay. my second question actually relates to the valuation of the EAS division. I think that's specifically relating to the discount rate. So I see that in the pre-expansion as well as the post-expansion scenario, you are using a WACC of 15%. Correct me if I'm wrong. So my question over here is, I'm just trying to understand, uh, would is there a case for the discount rate to be different under the two scenarios? How did you analyze the risks associated with the cash flows under, the pre-expansion scenario and the post-expansion scenario?
Right. I can start off if my teammates will add on more. As you can see over here, we actually just have two different WACC, even though it's actually the same value for its post-expansion and pre-expansion. We're both having a 15% WACC. And I understand your concern of whether we consider the risk factor. And we actually use the second method, the formula to calculate the WACC, to calculate discount rate rather than the WACC directly, as the discount rate consider the uncertainty risk, and we're able to have a similar value as 15% after the adjusting risk. So that's how we draw the conclusion to use the WACC as a discount rate directly for the discount cash flow approach.
Okay. All right. Thank you.
Thank you.
Did any of the other judges have any questions for Team 9?
I can go ahead. I guess before I do my questions, I'll just make a comment. On one of the pages, you have a 2.97 potential return, where you show the FMV compared to the capital raise and investments. I really like that you did that. I think when you do something like that, where you show a multiple, you should also show the internal rate of return, the IRR. I'm just giving that to you for future reference. And I'm glad you did that multiple. With respect to the term sheets, and you're going with William Wise, I believe. Would there be any changes to that term sheet you would recommend before or try to negotiate with William on?
That's a good question. I would say that in general, perhaps something we'd recommend with William would be that instead of it being a convertible bond, maybe something to do with the terms of suggesting it to be more converted, because we actually found that benefited the implied share price despite the share dilution. So shareholders would actually benefit from that. And in addition, the valuation of the company would be significantly higher. And we also believe that William Wise would be quite qualified to serve on the board. And unless there were any issues that Sarah and Jessica found when consulting with him, perhaps it would be a good idea to try to integrate perhaps more of an equity financing component rather than having convertible debt. And in terms of some of the other aspects, I would say that the general financial terms are pretty decent compared to what we have, except perhaps if he converts, maybe we could do something to reduce the kind of discount that he receives on his share price, because the implied share price without him gaining his 3 million additional shares would have been quite a bit higher, basically. So I'm pretty sure I calculated it in our Excel sheets, but I believe he received about a 40% discount or something compared to what he would have had to have paid at fair market value for those same 3 million shares. So something to make it more fair. But in general, I think that term sheet 2 was more reasonable and also more versatile.
Thank you. And then my last question, other than the information that you were provided, what, if any, external research information did you consider in preparing your presentation?
I guess I could just add on, and then my other teammates can add any other information. But we'd like to, in our conclusion, for instance, you could see that we believe that ESG consulting and especially energy as a service are really high growth industries right now. So that kind of impacts our earning multiples and how much we're considering the risk to be, because we believe that these are actually expanding quite a lot. Corporate social governance are, these sort of things are big concerns these days with climate change, as well as different government regulations appearing. So it's not really just a factor of the company acting even in goodwill, but sort of something that could even become a legal obligation in the future to have more green energy or to consider these environmental and social considerations. So we believed all that sort of stuff impacted our evaluations. And if any of my other teammates have anything, but I believe that's one of the key components.
I think Cedric answered the question pretty well.
Okay, great. Thank you. I'll see if any of my other esteemed judges would have any questions.
I can go next. Can we first flip back to page 6 of this slide? Yes, this page. So I'm comparing the two WACCs of the two different divisions, and I see that EAS division, you have a debt to equity ratio of 100%. If that's the case, wouldn't that imply my WACC would be 8%?
Right. So over here, we actually use a formula for counting the WACC. So it's not just like 8%, but like after using a formula, we're able to have 15%.
Oh,
Yeah.
oh, so it means it's 1-to-1. My apologies. So right, okay. Right. So my next question, yeah, you're correct. My next question is, what input is your valuation model most sensitive to? And if you identify such inputs, how your valuation would change if my inputs were to become different?
I guess I could start on answering that one. That's a good question as well. And I think something that's quite important for considering how evaluations like this can change is the projected models for our earnings. And I think that's it might be perhaps a bit ambitious on the part of Greenwave, because they want to receive a valuation that provides a more clearer and pretty picture of their potential finances in the future. So if we could potentially factor in a multi-scenario analysis of different projected earnings for Greenwave's energy as a service expansion, that could potentially help reduce the sort of risk that we could receive in altering our valuation with the discrepancies in those numbers. So maybe then we could average them out and then come up with a different sort of altered DCF that would be maybe a little bit better. But we'd have to consult with the client on that to come up with some values that we could use instead, and maybe have more realism, and then a best case scenario, and then also a worst case scenario, and then work from there. But there is definitely a lot to consider that goes into this evaluation, since there was much information given to us by the client, and many of those factors were presumed, including, for instance, the operating debt to equity that we used in our WACC values. That could also change. The assumed risk could also change in calculating our weighted average cost of capital. So there are quite a few things that could change it, and the valuation could swing quite a few ways. But in general, we still believe term sheet 2 would be the best decision, and we still think that the expansion is economically feasible.
Wonderful. Thank you very much. That's all my questions. Good job.
If none of the judges have any further questions, I'll give you a second. But otherwise, you'll be moved to a breakout room momentarily. Team 9, excellent job on your presentation. Really well done. You can stop sharing your screen and leave the meeting.
Thank you so much, everybody. Have a great afternoon.
Thank you so much.
Everybody.
Thanks, everyone.
I think we should join the breakout.
We'll get you in a breakout room in a second.
What's the key to unlocking value in the business world?
For over 50 years, CBV Institute has set the standard for excellence in the business valuation profession. The CBV program of studies continues to be regarded as the gold standard in business valuation education, and our members remain highly respected and in demand throughout Canada and the rest of the world. By setting a high bar for our students, our members, and the business valuation community at large, we ensure the ongoing integrity and authority of the CBV designation. The status quo is never good enough, however. Through thought leadership, ongoing curriculum enhancements, and consultation with global regulators and standard setters, we make sure to stay at the forefront of industry developments and trends, keeping our members and students well positioned for continued leadership in the business valuation profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
The CBV designation is more than just a professional title. It's a gateway to a wealth of opportunities in the finance and business worlds. I'd like to elaborate on 5 of the key benefits that members tell us they enjoy as a result of being a CBV. 1. CBVs enjoy extremely diverse career opportunities. CBVs work in a wide range of areas, including corporate finance, transaction advisory, income tax and estate planning, litigation support, financial reporting, and much more. In short, CBVs are needed wherever and whenever an assessment of value is needed to drive a key business decision. 2, because of our high-quality education and professional standards, CBVs are highly sought after and have in-demand expertise. Demand for CBVs and CBV services has never been higher. CBVs are the go-to professionals when businesses or individuals need to understand value, and their skills are crucial in deal-making, litigation, and many other strategic decisions. 3, the CBV designation is respected worldwide, which opens doors to international opportunities, including working on cross-border projects or working overseas. Now, these 3 points taken together means that CBVs have extraordinary job security, which is extremely important in a constantly evolving economic and technological landscape. There will always be demand for valuation expertise. And of course, there are significant financial benefits to being a CBV. Most newly designated CBVs will enjoy a salary bump, and they often command starting salaries approaching or exceeding 6 figures. But most importantly, our members truly find value and have fun in their work, and they love what they do. They're at the forefront of financial market developments. They are leaders in finance and business, and they are constantly learning and adapting to interesting new challenges. As a CBV, you'll develop the unique ability to see what others might miss in the world of business. You'll uncover hidden value, navigate complex challenges, and make a real impact in organizations across a broad spectrum of industries. If you're ready to join a global community of valuation leaders and take your career to new heights, the CBV designation is your path forward. I invite you to embrace this transformative journey and discover the power of seeing beyond the numbers.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What's the key to unlocking value in the business world?
Becoming a CBV is a journey of personal and professional growth. The path to becoming a CBV is relatively straightforward. First, individuals must complete our globally respected program of studies, which delivers practical and relevant business valuation education. After completing the program of studies, the next milestone is the Membership Qualification Exam, or MQE. The MQE is a case-based 4-hour capstone exam, and it assesses your ability to respond to real-world situations that you may encounter as a practicing CBV. Individuals who pass the MQE are eligible to apply for membership. Before applying for membership, there are 2 more requirements. First, because practical experience is crucial in any profession, we require a minimum of 1,500 hours of business valuation or related experience. Because most individuals are working full-time as they work through the program of studies, they have earned their hours by the time they're ready to write the MQE. Secondly, individuals must have a 4-year degree from a recognized post-secondary institution. This means that university students can start the program of studies when they're still in school, but you do need your degree by the time you apply for membership. While a background or degree in finance or business is helpful as you move through the program of studies, it's not a requirement. Business valuation is a multifaceted profession that calls on a variety of skills and aptitudes, with an inquisitive mindset and excellent communication skills being high on the list. The journey to becoming a CBV is a rigorous path, but one that leads to immense opportunity and a rewarding career.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
Our globally respected CBV program of studies is the cornerstone of the CBV designation. It's designed to deliver practical, relevant business valuation education that places new CBVs at the forefront of business and finance. The program consists of 4 core courses that provide a robust foundation in valuation methodologies and real-world applications. Students also choose 2 out of 4 elective courses, which allows them to specialize in areas such as private investments, litigation support, corporate finance, or valuation for financial reporting, all incredibly important topics. What sets our program apart is its practical, market-driven curriculum. Our content is designed by CBVs for future CBVs, and it undergoes regular updates to reflect current best practices and relevant topics. This means our students are learning directly from industry leaders, and they're gaining knowledge and developing skills that are directly applicable in the workplace. We've built the program to be flexible and accessible. With online, self-paced learning, opportunities to connect with instructors and peers, and courses offered 3 times per year, students can complete the program while working full-time. Plus, all materials and exams are available in both English and French. It's a rigorous program that thoroughly prepares our students to excel as CBVs. Upon completion, they have the in-demand skills and knowledge to succeed in this dynamic, rewarding profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
For over 50 years, CBV Institute has set the standard for excellence in the business valuation profession. The CBV program of studies continues to be regarded as the gold standard in business valuation education, and our members remain highly respected and in demand throughout Canada and the rest of the world. By setting a high bar for our students, our members, and the business valuation community at large, we ensure the ongoing integrity and authority of the CBV designation. The status quo is never good enough, however. Through thought leadership, ongoing curriculum enhancements, and consultation with global regulators and standard setters, we make sure to stay at the forefront of industry developments and trends, keeping our members and students well positioned for continued leadership in the business valuation profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
The CBV designation is more than just a professional title. It's a gateway to a wealth of opportunities in the finance and business worlds. I'd like to elaborate on 5 of the key benefits that members tell us they enjoy as a result of being a CBV. 1. CBVs enjoy extremely diverse career opportunities. CBVs work in a wide range of areas, including corporate finance, transaction advisory, income tax and estate planning, litigation support, financial reporting, and much more. In short, CBVs are needed wherever and whenever an assessment of value is needed to drive a key business decision. 2, because of our high-quality education and professional standards, CBVs are highly sought after and have in-demand expertise. Demand for CBVs and CBV services has never been higher. CBVs are the go-to professionals when businesses or individuals need to understand value, and their skills are crucial in deal-making, litigation, and many other strategic decisions. 3, the CBV designation is respected worldwide, which opens doors to international opportunities, including working on cross-border projects or working overseas. Now, these 3 points taken together means that CBVs have extraordinary job security, which is extremely important in a constantly evolving economic and technological landscape. There will always be demand for valuation expertise. And of course, there are significant financial benefits to being a CBV. Most newly designated CBVs will enjoy a salary bump, and they often command starting salaries approaching or exceeding 6 figures. But most importantly, our members truly find value and have fun in their work, and they love what they do. They're at the forefront of financial market developments. They are leaders in finance and business, and they are constantly learning and adapting to interesting new challenges. As a CBV, you'll develop the unique ability to see what others might miss in the world of business. You'll uncover hidden value, navigate complex challenges, and make a real impact in organizations across a broad spectrum of industries. If you're ready to join a global community of valuation leaders and take your career to new heights, the CBV designation is your path forward. I invite you to embrace this transformative journey and discover the power of seeing beyond the numbers.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you
for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What's the key to unlocking value in the business world?
Becoming a CBV is a journey of personal and professional growth. The path to becoming a CBV is relatively straightforward. First, individuals must complete our globally respected program of studies, which delivers practical and relevant business valuation education. After completing the program of studies, the next milestone is the Membership Qualification Exam, or MQE. The MQE is a case-based 4-hour capstone exam, and it assesses your ability to respond to real-world situations that you may encounter as a practicing CBV. Individuals who pass the MQE are eligible to apply for membership. Before applying for membership, there are 2 more requirements. First, because practical experience is crucial in any profession, we require a minimum of 1,500 hours of business valuation or related experience. Because most individuals are working full-time as they work through the program of studies, they have earned their hours by the time they're ready to write the MQE. Secondly, individuals must have a 4-year degree from a recognized post-secondary institution. This means that university students can start the program of studies when they're still in school, but you do need your degree by the time you apply for membership. While a background or degree in finance or business is helpful as you move through the program of studies, it's not a requirement. Business valuation is a multifaceted profession that calls on a variety of skills and aptitudes, with an inquisitive mindset and excellent communication skills being high on the list. The journey to becoming a CBV is a rigorous path, but one that leads to immense opportunity and a rewarding career.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
Our globally respected CBV program of studies is the cornerstone of the CBV designation. It's designed to deliver practical, relevant business valuation education that places new CBVs at the forefront of business and finance. The program consists of 4 core courses that provide a robust foundation in valuation methodologies and real-world applications. Students also choose 2 out of 4 elective courses, which allows them to specialize in areas such as private investments, litigation support, corporate finance, or valuation for financial reporting, all incredibly important topics. What sets our program apart is its practical, market-driven curriculum. Our content is designed by CBVs for future CBVs, and it undergoes regular updates to reflect current best practices and relevant topics. This means our students are learning directly from industry leaders, and they're gaining knowledge and developing skills that are directly applicable in the workplace. We've built the program to be flexible and accessible. With online, self-paced learning, opportunities to connect with instructors and peers, and courses offered 3 times per year, students can complete the program while working full-time. Plus, all materials and exams are available in both English and French. It's a rigorous program that thoroughly prepares our students to excel as CBVs. Upon completion, they have the in-demand skills and knowledge to succeed in this dynamic, rewarding profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
Hello, Team 17, and welcome. We're going to get started momentarily now. We're just waiting for the judges to come back from their deliberation break, where I think we're waiting on one who should be here momentarily. If I could get the screen to stop being shared, thank you. Okay, Team 17, everyone's here. Best of luck to you, and go for it when you're ready.
Hello everyone, we are Insight Valuations and today we'll be evaluating Greenwave. My name is Malaysia and I would like to introduce my colleagues Estelle, Gabriel, and Alexander. We're going to start off with a case overview, followed by analyzing Greenwave's current market value, discussing the E's expansion, and evaluating the two term sheets that were given, and ending off with a recommendation.
The case overview. The case overview consists of three parts: company profile, client demands, and results and solutions. Starting with company profile, we are given a private Canadian company named Greenwave, which is comprised of two different divisions, ESG Consulting and EAS, with the main goal being going public. Additionally, Greenwave aims to secure a $30 million deal, which will increase its provision of services to a larger number of people with the help of the additional funds. Moving on, client demands. The case asks us to do a thorough evaluation of ESG Consulting and EAS current operations, followed by a meticulous valuation of ESG expansion program and its potential to attract $30 million in funding. Lastly, when it comes to client demands, Insight Consulting compared the two term sheets in qualitative and quantitative aspects to finalize its recommendation. Finally, our analysis gave us the following results and solutions. Specifically, the fact that Greenwave's fair market value is $114 million, and that's for its two subdivisions, ESG Consulting, reaching $72.9 million and EAS $41.7 million in fair market value. In addition, we found that the fair market value after the expansion is a whopping $104.1 million, hence supporting the $30 million investment. Ergo, at the end of our research, we conclude that based on the client's demands and the shareholder agreement, we believe Greenwave should pursue term sheet B.
Now, moving on to the Greenwave valuation. Before we get into the numbers, we wanted to explain our rationale for two things. One, why we used different valuation methods for the two divisions, and two, why we used capitalized earning for the ESG Consulting division. Firstly, we decided to use two different valuation methods because ESG Consulting and EAS are in two very different phases of the business cycle. While ESG Consulting is a mature division within a mature firm, EAS operates much like a startup now. Why capitalized earning for ESG? First of all, they have stable cash flows. As mentioned, they're a mature firm in a mature industry. They have a consistent growth rate of 4% that matches the industry growth rate. Last thing we want to talk about is our secondary valuation. We considered the market approach but decided to exclude it because of the nuanced factors it would not take into account, such as the lawsuit, the recent acquisition, and the acquisition-related expenses. Our assumptions for the calculation include the following. For the estimated normalized income after taxes, we use a maintainable cash flow approach. For the low point, we decided to have an equal weightage across the 3 years. For the high point, we used an ascending weightage, putting the most weight on the most recent year. For our rate of return, we used WACC, and you can see the WACC calculations on the bottom left of our slide. For capitalized earnings itself, we started with an EBITDA and applied the normalizations. First of all, the lawsuit. We paid $58 million in 2023 and the rest in 2024. Next up are acquisition and acquisition-related expenses. Firstly, management salaries. Kristen's salary is above market, so we subtracted $100K from 2022 and 2023. The acquisition itself took place in September of 2022. Greenwave's fiscal year ends in August of 2022, so we decided to include it in the next year, 2023. Same with the revenue adjustment. After the acquisition, the spike in revenue for Greenwave, it was because of the acquisition, not the operation, so we deducted the spike. Earn-out payment was something that was negotiated during the acquisition, but it had the clause of EBITDA being more than $2 million for 2023 and 2024. Because that was not the case, there was no earn-out payment. Lastly, because of a lot of staff leaving after the acquisition, we had to incur one-time training expenses to train the new staff. Lastly, marketing expenses to attain new clients after our lawsuit. That gave us an adjusted income. Next, we use the 26.5% tax rate to calculate income taxes. And we also deducted CapEx to get our normalized income. Once we had our normalized income, as mentioned before, we use the maintainable cash flow approach to get the low point, the high point, and then the midpoint using the average of the two. Then we use our 14% WACC minus the 4% growth rate to get a capitalization rate of 10% and a capitalized value of $72,347,000. Then we added the tax shield, calculating the UCC given, giving us an enterprise value of $72,369,000. Lastly, we added the intangible asset, which are the patent that GreenWave holds, but it's not planning to use. Regardless, it's important to add the value of those assets, giving us a final equity value of $72,869,000.
Then we'll value Ease's fair market value. For this, we adopted a market-based approach. There are 3 questions we considered before getting into the valuation. Firstly, why using this valuation approach? Secondly, why choosing EcoGlow as the comparison company? And lastly, why using an EBITDA multiple? In choosing the market-based approach, we also took into account DCF and cap earnings as secondary methods. But market approach still stands out the most among the 3. 3 reasons for that. Firstly, information on comparable companies are already available. And secondly, Ease is a capital-intensive division, so it requires substantial and often irregular capital investment to maintain and grow its operation, which a forecasted future cash flow often fails to address. Therefore, the DCF approach is inappropriate. Thirdly, this division is just starting up and has not yet operated stably as required by the capitalized earnings approach. And then we move on to assess which companies are comparable to Ease. By calculating the EBITDA and revenue multiples of all 6 reference companies, we observed a huge difference between EcoGlow's and other 5 firms' multiples, which means that EcoGlow is actually not compatible with the other 5 firms, and simple averaging all 6 firms' multiples would not present an accurate picture. Therefore, we narrowed down our options to either EcoGlow's or the average of all other 5 firms' multiples. And EcoGlow is more appropriate in this case because, firstly, it is also characterized by low EBITDA. And secondly, if we look at the business model of EcoGlow, it's a private Canadian company that installs and upgrades lighting as well as HVAC systems via leases, which is almost exactly the same as Ease's business model. Therefore, its operations is most similar with Ease's in terms of geographical presence, size, industry, core operation, and stage of business cycle. And then in terms of multiple, we chose EBITDA multiple over revenue multiples because it better reflects the actual cash flows of the division and depicts Ease's core operational efficiency better. And at the bottom of the slide, you can see how we get that EBITDA calculation. And next slide, please. From this table, we took EcoGlow's value and divided it by its EBITDA and got a multiple of 84.67. And then we multiplied it by Ease's EBITDA of $493,000 to get its fair market value of $41.741 million. We also took into account the industry valuation rules of thumb. It outlines that for Ease division is $1.5 million for enterprise value per contract and $6 million of enterprise value for the last 12 months of new installations. Multiplying 1.5 by 15, we can get an enterprise value of $22.5 million for existing customers. And with the same step, the enterprise value for new installations should be $30 million. Together, the total enterprise value should be $52.5 million. This generally agrees with our calculation, but with some discrepancy, which is because the rules of thumb did not take into account the risk premium that Ease's current stage should add. And now I'll pass it on to Elijah.
Now we would like to compare GreenWave's fair market value to its Series A round investment. We know that Earthwise invested $25 million in GreenWave in 2021, securing 35% of the company and implying a valuation of $71.4 million. We know now GreenWave's current fair market value is $114 million. So if we take 35% of the company, subtract the initial investment, and divide it by the initial investment, we get an ROI of 59.6%.
Thank you, Alicia. Before diving into the calculation of the proposed expansion fair market value, we'll first walk you through our analysis of the forecast. We relied on the expansion forecast prepared by a reputable third-party firm, assuming that it was completed without conflicts of interest and in accordance with professional standards. Given GreenWave's growth on its EAAS division during the last 3 years and rapidly reaching its maximum capacity, we concluded that the forecasted numbers are both realistic and achievable. We made only one slight adjustment to the forecast. When calculating the terminal value, we considered it unlikely that all 90 clients will automatically renew their contracts upon reaching full capacity. To account for these, we assumed a 3% client attrition rate and included associated client acquisition costs. As highlighted on our analysis that you're seeing right now, this is a capital-intensive business line that will experience negative cash flows for the first 3 years of expansion. By year 4, when 80% of the maximum capacity will be utilized, we are expecting the cash flows to turn positive. By year 5, when maximum capacity is reached, we expect cash flows to stabilize and grow consistently at an annual rate of 2.5% as outlined in the contracts with current clients. Before moving on to the fair market value determination, let's review our chosen valuation method and other key factors. We selected the discounted cash flow method as the most appropriate approach for 3 main reasons. First, the fluctuations expected over the next 5 years. Secondly, the early stage nature of this expansion. And thirdly, and most important, the availability of a reliable forecast. The determination of an appropriate discount rate was critical to establishing a sound and defensible fair market value. First, we calculated the weighted average cost of capital using the industry rates for the EAS sector provided in the case. However, this alone did not fully capture the minimum return required by investors for a project of this nature. To adjust for this, we added a risk-free rate for a 5-year investment and a premium for uncertainty, given the capital-intensive requirements and fluctuations expected for this business line. After adjusting for an inflation rate of 2.5%, we arrive at a final discount rate of 19.05%. Factoring in the expected growth rate, the capitalization rate was finalized at 16.59%. Turning to the determination of the fair market value, after obtaining the projected EBITDA for each year, we normalize the customer acquisition costs, treating them as non-recurring items. We then deducted income taxes at the current rates of 26.5% for GreenWave, as well as the sustaining capital expenditures net of the tax shield to arrive at the adjusted after-tax cash flows. Using the 2029 figures and accounting for a 3% client loss rate, we derive the terminal year cash flows. By discounting these cash flows to present value, applying our previously calculated discount rate and adding the tax shield on the existing UCC, we arrive at a fair market value of approximately $104 million. With all of these factors considered, we reached 4 solid conclusions regarding the proposed expansion and anticipated capital raise. First, this business line is highly capital intensive. Without the anticipated capital raise, the EAAS division will remain at current capacity, unable to grow. Thus, the capital raise is necessary to expand and achieve positive cash flows and maintain them. Secondly, we see a 250% fair market value increase when comparing current operations of the EAS business line to the forecasted expansion. Additionally, revenue from the consulting division is expected to grow, as 40% of the EAS clients generate $250,000 annually in consulting fees. Therefore, as more clients are brought into the EAS business line, we can expect increased revenue for the consulting division as well. Although we did not factor this revenue into the fair market value of the EAS expansion, since it doesn't directly impact the division itself, it remains relevant when evaluating the term sheets in further detail. Finally, we conclude that our valuation aligns with industry standards based on past transactions involving similar companies. EBITDA multiples for mature businesses range between 2.02 and 3.43. Considering the terminal year EBITDA, at which point the EAS business line will reach maturity, our valuation reflects an EBITDA multiple of 3.047. In conclusion, we can confidently affirm that the fair market value of the EAS expansion supports the anticipated capital raise and aligns with the best interests of current shareholders.
Then let's delve into the term sheet analysis. Next slide, please. Basically two term sheets were offered to GreenWave. First one is from SEV. It wants to invest $30 million in exchange for 25% of preferred shares with cumulative dividend of 20% of face value of the preferred shares per year. If the full amount of annual dividends are not paid for 3 consecutive years, the shares are immediately retractable at face value plus outstanding dividends. On the other hand, William offers to lend Greenwave $30 million in the form of convertible debt with 8% interest per year. The debt matures 5 years from issuance, and at that time point, the principal can also be converted into 3 million common shares of Greenwave. This slide on value of ownership before versus after expansion really helps us understand, firstly, which of the 2 term sheets can give the existing shareholders more value of ownership after expansion in both absolute and percentage terms. It also demonstrates if the value growth brought by Series B round is enough to compensate for the dilution of ownership under both term sheets. From this table, we can find out that the absolute value of ownership grew from approximately $27 million to $31 million under term sheet 1, while grew to $34 million under term sheet 2 from the last 2 columns of both table. And term sheet 2 also enables more percentage ownership left for existing shareholders after dilution. As we can see, the ownership percentage for Sarah and Jessica declined from 24% to 18% under term sheet 1, compared with a smaller decline to 19.32% under term sheet 2. And from the last 2 columns, we can see both term sheets bring a value growth that is enough to compensate for the impact of dilution. And then we'll delve into the qualitative part.
Thank you, Estelle, for the quantitative analysis. I'll now handle the qualitative part. As we can see, there are 5 factors which we took into consideration when comparing and contrasting the 2 term sheets. Starting with factor 1, value of ownership after dilution. In term sheet 1, value of ownership increased from 27 to 31 million for Sarah and Jessica. Ownership percentage dropped from 24 to 18%. Whereas in term sheet 2, the value of ownership increased from 27 to 34 million for Sarah and Jessica. And even though ownership percentage dropped, it's slightly higher than term sheet 1. Falling to 19%. Moving on to factor number 2, control over the company after going public, anti-dilution right. SCV asked for anti-dilution rights and at least a 20% ownership of the Greenwave, largely reducing our client's ownership for the company. Contrastingly, Williams shares also get diluted as more shareholders join. Moving on to factor number 3, cash flow considerations. We see that dividends are 20% of the cumulative face value with a dividend cash flow of 30 million times 20%. That gives us 6 million in dividend payments per year. Essentially, SCV will have retracted shares, which will be an additional burden on Greenwave's cash flow as they will have to pay back their face value of shares plus the outstanding dividend if they fail to pay back in 3 consecutive years, resulting in a massive $48 million loss for Greenwave, which is calculated by adding face value plus outstanding dividends. Moving on to term sheet 2, the principal to be paid is 30 million, interest rate is 8%, and the interest payment, which is 2.4 million times the tax rate of 26.5%, results in a tax savings of 636,000 per year. Factor number 4, how much does it help Greenwave to go public? It is evident that SCV's commitment to the growth of its investments in-house investment advisors and previous experience in helping companies go public is a valuable asset. However, advisors do not have experience with companies in ESG consulting or EAS. On the other hand, there is no anti-dilution rights required by William. And finally, for our factor number 5, shareholders agreement, Greenwave pays dividends to its preferred and common shareholders if the following 3 criteria are met. Number 1, total dividends declared in each fiscal year don't exceed Greenwave's net income of the same fiscal year. Number 2, dividends are not paid from borrowed funds. And number 3, Greenwave has to buy back its shares at face value plus the cumulative dividend of 20%. On the other hand, in term sheet 2, longer time is allowed to pay back the principal and flexibility of payback method, choosing between share issuance or cash. Therefore, term sheet 2 is a double-ended benefit because it offers tax savings and reduced outgoing cash flows. Contrastingly, term sheet 1 is a double-ended loss because we have to pay more in cash flows, leaving GreenWave with less liquidity and making it more difficult for it to go public. So to reiterate, our final recommendation is to choose term sheet 2 for the following 3 reasons. That is value and control for less dilution of other current shareholders. Number 2, taxes, debt provision cuts down tax expenses. And finally, assistance with GreenWave's goal, which provides flexible principal payment schedule and no anti-dilution rights required. Thank you for watching our presentations. And if you have any questions, we'll be more than happy to answer them.
I've got a question on slide 7, in the capitalized earnings approach. If you could talk a little bit more about why you assigned the weightings that you did to each year. And then secondly, if you could also talk about how you established the lowest and highest point for your valuation, because they don't seem to match the normalized income.
So for the first part, which is how did we get our low and high? So for the lowest point, we used an equal weightage for all 3 years. So we multiplied each of the normalized income years by 0.33. For the highest point, we did 0.2 in 2022, 0.3 in 2023, and 0.5 in 2024. We wanted the highest weight to go to the most recent year to reflect that it's the most recent year. And the midpoint is just the average of the low and high.
And sorry, it cut out a little bit. I missed why the highest weighting was to 2024.
Because it's the most recent year.
And were there any other factors that you considered as well?
Yes, that's correct. And just to follow up on what Walija is saying here, in 2022, the merchant acquisition was not yet completed. That's why we are assigning the lowest weighted average of 0.2, since it's still something valuable to have the year 2022 operations, but it's not as valuable as having 2023 and 2024. We're assigning the highest weight to 2024, not only because it's the most current year, but also because the operations were starting to normalize after the merchant acquisition.
Okay, thank you.
I guess I can go ahead. On page 10, I see that I think it's page 10, you incorporated ROI, and this is just a comment. I guess really happy you included that. Just consider for future to think about a multiple of cost as well, and perhaps an internal rate of return. But I really like that you did that there. With respect to other information incorporated in your analysis, was there anything else you considered that wasn't provided in the materials? The case.
Thank you so much for the feedback. We really appreciate it. But in terms of external research for our calculations, do you have a specific calculation or part, or just overall what other information we took into regard?
Any information you considered outside of the case?
I can start with that question, and then if anyone else wants to add something. First, for determining the fair market value of the expansion of the EAS business line, we added a risk premium. That risk premium was not included in the case, and it was something that we weighted from our research based on similar companies that are unstable, that have a really high capital intense requirements, and also they are in that startup point of the business cycle. That's why that's how we calculated the, let me just tell you, the 3.2 uncertainty risk.
Anything else? I have one more question, but is there anything else there with respect to external information used?
Yes, and in terms of the ROI, we also took a look at the what are some industry leaders' ROI statistics, and we found the industry leaders' ROI statistic to be approximately 12.9%, indicating that the current GreenWave has a relatively high ROI.
Okay, thank you. With respect to the term sheets, and you've chosen one term sheet over another, is there any changes to that term sheet you would recommend to negotiate with the other party?
I can take that one, and everybody can add on to it as they see fit. So first of all, I think we can negotiate a lower interest rate and then a longer period of payment, because right now we have 5 years to pay it back, which works because our EAS division is in negative cash flows for the first 3 years, and then we get into positive cash flow for year 4 and year 5. But if we have a longer period, of course, that helps the company pay it off better.
Just to assure that liquidity that we have, as we can see here on the year number 5, we're expecting to have cash flows of about $36 million. So if we need to repay the principal of $30 million, if that's what William chooses instead of issuing shares, that we do not have a liquidity issue. However, it might be a struggle for the company for future expansion plans. What we could negotiate is just to have a longer expected return of that capital, but also always encouraging William to go for the issuance shares part.
Okay, thank you.
I had a couple of questions. If you could go to the slide where you discussed the WACC, the discount rate. Yeah.
I think the DCF discount rate that's you're referring to.
This is the slide that I'm referring to. Can you walk me through how you are incorporating where are you incorporating the inflation rate anywhere in the analysis, and also the uncertainty risk of 3.2%? I know you mentioned that's an additional input. How did you determine that, and what were the factors that you considered? And it's a very specific number, so I was wondering how that was quantified.
Yeah, that's a wonderful question. First, we got the weighted average cost of capital by analyzing the cost of debts and then the cost of equity that was provided in the case, and weighting the properly 50 and 50%, as it was mentioned that it was appropriate for the industry, a 1-on-1 ratio debt to equity. After getting the weighted average cost of capital, just walking you through the numbers, it was 15% plus the 3.7 risk-free rate plus the 3.20 uncertainty risk, and all of that divided by 2.5% to adjust for the inflation rate, and that's how we got to the number 19.09%. And just going very quickly through the uncertainty risk, it's a very specific number since we got it from 3 different weighted averages. First, we consider premium risk that a lot of startups companies, such as the EAS division, uses. The secondly is for the weighted of some companies that they are really highly intensive capital. They were not specifically providing energy as a service, but they were especially companies that looked negative cash flows on the first years. And thirdly, for also current companies that they were having a lot of capital requirements in order to sustain the investments. And that's how we got to the number 3.20%.
Thank you. In one of the slides, when you were discussing the methods to be used and why they are different for EAS and ESG, you mentioned that ESG is a mature company in a mature industry. So, what were the factors that you considered to make that determination?
I can take that one. So in the case, when it's introducing the companies to us, it tells us that the ESG industry itself has become a mature industry now, and the firm also falls in that. And one of the things that they gave us, the industry growth rate is 4%, and our firm's growth rate is also 4%.
Okay. All right. Thank you.
All right, very good presentation, very good efforts, and I especially you guys incorporate a attrition rate and also a client acquisition cost. Maybe just enlighten me a little bit. How did you get your attrition rate of 3%, and what did you consider in your acquisition cost analysis?
That's a wonderful question. First of all, the acquisition cost analysis, it was provided in the case, and we, as we mentioned, rely on the forecast. It was carried by a third party that is a really reputable firm. So that's from where we took the client acquisition cost that it's provided per client analysis. The 3%, we also got it from external sources, just analyzing how much they vary on this kind of industries where they follow the same pattern of leasing different types of equipment, maybe again, not energy as a service, but also HVAC and other type of leasing, reducing the upfront cost for the main clients.
Right, wonderful. If we can go back to slide 13 again, I know we have been pounding you on the WACC calculation. I think what Kinjal was alluding to, obviously we are not going to penalize you for it, is that the cost of equity actually incorporates the risk-free rate of the 3.7. It would have been inside the 22%. Obviously, this is something that's much more technical that are not given the case, but requires further studying. Just so you know, by adding additional risk-free rate on top of cost of equity, that would be double counting the risk. Obviously, you can label it something different, call it the risk of achieving synergies, expansion, etc. But just something for future reference. My final question relates to the composition of the board. So I understand you analyzed the pros and cons of the share percentages. I wondered if you have taken into account how the board would change and how would each position, term sheet 1 or term sheet 2, would affect your operations based on the changes in the board.
I can take that one. So first of all, thank you so much for the feedback. We'll definitely keep that in mind for future case comps. And regarding the board of director questions, we know that in term sheet 1, the SEV would appoint a board of director, and the board of directors that Sarah and Jessica jointly appointed would be removed. Whereas in term sheet 2, William would add an additional board of director. So we'll have 6 board of directors instead of 5. While we were evaluating both term sheet, he concluded that it's better to add another board of director than a board of director that we appointed being removed.
Okay, wonderful. Thank you so much. Great job.
All right. If there are no more questions, then judges, I'll ask you to head back to the breakout rooms. And for Team 17, great job, excellent presentation. You folks can leave the meeting as well. Thank you.
Thank you so much for all the feedback. We really appreciate it. Goodbye. Have a great day.
Such a pleasure. Thank you.
What's the key to unlocking value in the business world?
For over 50 years, CBV Institute has set the standard for excellence in the business valuation profession. The CBV program of studies continues to be regarded as the gold standard in business valuation education, and our members remain highly respected and in demand throughout Canada and the rest of the world. By setting a high bar for our students, our members, and the business valuation community at large, we ensure the ongoing integrity and authority of the CBV designation. The status quo is never good enough, however. Through thought leadership, ongoing curriculum enhancements, and consultation with global regulators and standard setters, we make sure to stay at the forefront of industry developments and trends, keeping our members and students well positioned for continued leadership in the business valuation profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
The CBV designation is more than just a professional title. It's a gateway to a wealth of opportunities in the finance and business worlds. I'd like to elaborate on 5 of the key benefits that members tell us they enjoy as a result of being a CBV. 1. CBVs enjoy extremely diverse career opportunities. CBVs work in a wide range of areas, including corporate finance, transaction advisory, income tax and estate planning, litigation support, financial reporting, and much more. In short, CBVs are needed wherever and whenever an assessment of value is needed to drive a key business decision. 2, because of our high-quality education and professional standards, CBVs are highly sought after and have in-demand expertise. Demand for CBVs and CBV services has never been higher. CBVs are the go-to professionals when businesses or individuals need to understand value, and their skills are crucial in deal-making, litigation, and many other strategic decisions. 3, the CBV designation is respected worldwide, which opens doors to international opportunities, including working on cross-border projects or working overseas. Now, these 3 points taken together means that CBVs have extraordinary job security, which is extremely important in a constantly evolving economic and technological landscape. There will always be demand for valuation expertise. And of course, there are significant financial benefits to being a CBV. Most newly designated CBVs will enjoy a salary bump, and they often command starting salaries approaching or exceeding 6 figures. But most importantly, our members truly find value and have fun in their work, and they love what they do. They're at the forefront of financial market developments. They are leaders in finance and business, and they are constantly learning and adapting to interesting new challenges. As a CBV, you'll develop the unique ability to see what others might miss in the world of business. You'll uncover hidden value, navigate complex challenges, and make a real impact in organizations across a broad spectrum of industries. If you're ready to join a global community of valuation leaders and take your career to new heights, the CBV designation is your path forward. I invite you to embrace this transformative journey and discover the power of seeing beyond the numbers.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? Come build tomorrow with us.
What's the key to unlocking value in the business world?
Becoming a CBV is a journey of personal and professional growth. The path to becoming a CBV is relatively straightforward. First, individuals must complete our globally respected program of studies, which delivers practical and relevant business valuation education. After completing the program of studies, the next milestone is the Membership Qualification Exam, or MQE. The MQE is a case-based 4-hour capstone exam, and it assesses your ability to respond to real-world situations that you may encounter as a practicing CBV. Individuals who pass the MQE are eligible to apply for membership. Before applying for membership, there are 2 more requirements. First, because practical experience is crucial in any profession, we require a minimum of 1,500 hours of business valuation or related experience. Because most individuals are working full-time as they work through the program of studies, they have earned their hours by the time they're ready to write the MQE. Secondly, individuals must have a 4-year degree from a recognized post-secondary institution. This means that university students can start the program of studies when they're still in school, but you do need your degree by the time you apply for membership. While a background or degree in finance or business is helpful as you move through the program of studies, it's not a requirement. Business valuation is a multifaceted profession that calls on a variety of skills and aptitudes, with an inquisitive mindset and excellent communication skills being high on the list. The journey to becoming a CBV is a rigorous path, but one that leads to immense opportunity and a rewarding career.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
Our globally respected CBV program of studies is the cornerstone of the CBV designation. It's designed to deliver practical, relevant business valuation education that places new CBVs at the forefront of business and finance. The program consists of 4 core courses that provide a robust foundation in valuation methodologies and real-world applications. Students also choose 2 out of 4 elective courses, which allows them to specialize in areas such as private investments, litigation support, corporate finance, or valuation for financial reporting, all incredibly important topics. What sets our program apart is its practical, market-driven curriculum. Our content is designed by CBVs for future CBVs, and it undergoes regular updates to reflect current best practices and relevant topics. This means our students are learning directly from industry leaders, and they're gaining knowledge and developing skills that are directly applicable in the workplace. We've built the program to be flexible and accessible. With online, self-paced learning, opportunities to connect with instructors and peers, and courses offered 3 times per year, students can complete the program while working full-time. Plus, all materials and exams are available in both English and French. It's a rigorous program that thoroughly prepares our students to excel as CBVs. Upon completion, they have the in-demand skills and knowledge to succeed in this dynamic, rewarding profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
Good afternoon, Team 18, and welcome to day 2 of the BV Challenge. Congrats on getting to the finals. We have all of our judges back in the room, so you're good to start. Whenever you're ready, you can go ahead and share your screen and kick things off. Good luck.
Thank you so much. Well, good afternoon, Sarah, Jessica, and the team. Then thank you so much for taking the time to meet with us again. My name's Akshat, and I'm joined today with my teammates, Gabriel and Saranish. And today we'll be walking through our final presentation on the questions you'd asked us based on the forecasts and qualitative factors provided to us in the last meeting. We will walk you through the main recommendation and then break down each aspect of the analysis to give you a better understanding of how we came to our conclusions on the current value of GreenWave, rationale to expand, post-expansion impacts, term sheets, risks, and finally some time for you to ask some questions at the end. We at Insight believe that you should expand the EAS division with the $30 million from William Wise. The current fair market value of GreenWave is approximately $83.8 million, which is an upside of approximately 18% from your Series A valuation with Earthwise, which was valued at $71 million. With the expansion prospect, we believe that the firm value can grow to 68% upside from today's valuation, which is 97% growth in 10 years from Series A to the end of Series B. Given that William does have a convertible option for ownership, in year 5, the dilution of ownership will bring you to 19%. And finally, to note, we do not suggest to include in your strategic plan an IPO in the next 5 to 7 years. And this is because GreenWave is in a growth stage, and we believe it's necessary for the growth to materialize for the EAS division. We note that the key consideration in all the numbers generated are based on the forecast provided and hence are reflecting of those values. Now we dive into all the different analysis that we did to get to current valuation. We'll break that down by division. For EAS division, we use the midpoint of the industry multiples and the long-term growth rate of 2.5% provided to us by you. We arrive at the value of approximately $54 million, and this is because the debt and cash are applied at the company level. Additionally, the 15% is based on the debt to equity of 100%, with cost of equity 22% and cost of debt 8%. The exit multiple is based on the median of the precedent transactions that were provided. As such, we determined that the present value of free cash flow is about $26 million, and at the terminal year of 2030, leading us to a terminal value of $59 million, which is adjusted for through the discount factor and then tax shield on the capital cost, which gives us about $18,000 per division. Similarly, for the 2.5% in the perpetuity growth method, we follow a similar FCF, but it generates a lower unlevered FCF. That provides us with a higher valuation, and hence we're able to have a better EV of giving us $54 million as the midpoint. I'll now pass it over to Ish to talk about the ESG's division current position.
Awesome. Thanks, Akshat. Now we'll talk about the ESG consulting current valuations. So we decided to move forward with a capitalized cash flow model. The capitalized cash flow model estimates a business's value based on expected cash flow growth in the future. And we've been provided with information that the expected cash flow growth of this company is 4%. So we decided this is an indicator for using the CCF model. Now, looking at the maintainable EBITDA, this is a crucial place to begin since it's highly sensitive in nature and it structures the entirety of our valuation. And I'll dive into the drivers in the next slide regarding this. But what we want to focus on here is the sustaining CapEx. We were provided with information that going forward, there will be $200,000 of capital expenditures. And we've used the net benefit of the tax shield to reduce this down to $189,000. In terms of the capitalization rate, this is the inverse of the adjusted WACC, and this growth factor was used to multiply by the net cash flow, coming down to a capitalized value for our existing operations. We also want to note that 50% of the tax shield is allocated to the ESG consulting division, so we've also added this to come down to a final enterprise midpoint value of approximately $26.9 million. Now, in terms of the WACC, it is a 75% debt to equity ratio, and we've also considered the inflation rate and growth rate. Now, moving on into the maintainable EBITDA, we begin with EBITDA itself, and then we apply normalizations. Normalizations are any irregularities in the company's cash flows or earnings that we need to add back since they are non-recurring. Essentially, we want to know what EBITDA would be under normal circumstances. So let's begin with Crystal's salary first. We know that her fair market value salary and what she is actually paid deviate by $100,000, so we've added this amount back. Now, if we look at the legal fees, the transaction costs, and the marketing expenses, due to their one-time nature and non-recurring, we've also decided to include this as well. Now, in terms of the cost of revenues, we've compared it to 2022, and we've noticed that in 2023 and in 2024, they're unusually high. So we decided to smooth them out by using the 2022 gross profit percentage. Now, lastly, in terms of Crystal's earnout, we know that her 10% earnout is dependent on if EBITDA exceeds $2 million. So we've taken what she actually is paid out in the earnout versus what she's expected to be paid out, and we calculated this difference and added this amount back. Now, in terms of the selected maintainable EBITDA, this is the weighted average of the 2023 and 2024, since this is when these normalizations and significant costs have been incurred. And we've come down to a low and high maintainable EBITDA of 4.8 million and 4.852 million. Now I'll pass it on to Gabriel to talk about the tab.
Thanks, Sesh. So here we calculate the tangible asset backing tab for GreenWave's current operations. Practically, TAB is a measure of risks that's used alongside our cash flow valuation methods, and it represents how much of GreenWave's value is supported by tangible assets. To calculate TAB, we'll start with the book value of net assets and adjust these to fair market value. These adjustments include the valuation of the smart water system patents, and additionally, goodwill on the acquisition of Ecovision is adjusted to 0 to avoid double counting, as we'll assess GreenWave's goodwill separately on a gross basis. We've also accounted for an unrecorded contingent liability equal to $420,000 stemming from negligence in the ESG consultant department. Having calculated the fair market value of net assets, we then exclude redundancies, which are items that don't affect the firm's operating risk. These redundancies include the patents and any excess cash beyond what's needed for working capital. This gives total redundancies of $2.75 million, which will be treated separately in our build-up to GreenWave's fair market value. Lastly, here we show the calculation of the present value of the tax shield on GreenWave's existing UCC balance. Here we multiply the UCC balance by the CCA rate and the tax rate and divide the product by the rate of return and the tax rate. That gives us a present value of $36 million, which, as we saw earlier, is allocated equally to the two departments. Moving on to the fair market value of GreenWave's total operations, we start by adding the enterprise value of the two departments to give us the total enterprise value for the firm. Then we include redundant assets we just calculated to reach the overall fair market value. The CCA tax shield is already incorporated into the EV, so there's no need to add it separately here. We show both the low and high fair market value scenarios, but we conclude on the midpoint, and that yields an equity value of $83.9 million. And based on the current number of outstanding shares, this implies a share price of $6.77. Below, we show that fair market value can alternatively be broken down between goodwill, TAB, and redundancies. In GreenWave's case, goodwill comprises of substantially all that value. And this isn't uncommon for early stage firms. We also have evidence that this goodwill is commercially transferable based on the Series A issuance. However, we recognize that high relative goodwill does translate to higher risk. When an investor buys equity in GreenWave, they're effectively buying future cash flows without the safety net a higher tangible asset backing would provide. If those cash flows aren't realized, an investor could potentially lose their entire investment. So let's discuss why we propose expanding the GreenWave Energy as a Service department. First, GreenWave's ES division is already operating at full capacity, which limits their growth potential. While there's demand for these services, GreenWave needs additional financing to reach that untapped market. The ES division has strong customer retention, and that's a significant advantage that's supported by their 3-year contract model, which provides stable and predictable revenue. Demand is increasing, especially among commercial and industrial clients. Key growth drivers for expansion include the synergies between departments. GreenWave has successfully cross-sold their ESG consulting services to around 40% of their existing ES clients, and they expect to scale the success with their expansion. The expansion also supports long-term profitability, with projections to break even by about year 4. Meanwhile, the ESG consulting department will continue to earn EBITDA of about 18%, which will help cover the cash flow shortfalls in the early stages of expansion. Now I'll hand it off to Anstar to talk about our expansion valuations.
Thanks, Gabriel. So now let's take a look at the valuation post-expansion. We estimated the value of the EES division post-expansion to be somewhere between $133 million and $147 million. To arrive to those numbers, we use a discounted cash flow model that allows us to capture the unique risk profile of this project and account for the temporary fluctuations in revenue and costs, especially in the first few years. Additionally, we did have enough reliable information to be able to prepare a free cash flow forecast, making the DCF a better and more accurate valuation approach. So first, we calculated the PV of the forecasted cash flows over the next 7 years, then applied 2 methods to estimate the terminal value. We used the median EV to EBITDA ratio of 5.14, which is based on precedent transactions provided for the exit multiple model, and a perpetuity rate of 2.5% for the terminal growth model. Both of the terminal values were then discounted at a rate of 15%, which is the WACC for the ES division, based on an optimal debt-to-equity ratio of 1. We also factored in the PV of tax shield on existing UCC attributable to the ES division. Other key assumptions in our model includes revenue growth of 2.5% and annual sustaining capex of $500,000 once the division reaches capacity. We've also factored in the use of non-capital taxes to minimize future tax liability. Next, based on the precedent transactions related to the ES divisions, we've calculated the EV to EBITDA and EV to revenue multiples. We came up with a multiple of 5.14, which was used in the previous slide, by looking at the median ratio of the 4 most comparable transactions. Our rationale behind using the median instead of the average was because it provides a more accurate representation of central tendency. Based on the current valuation of $54 million, the EV to revenue ratio is 1.6, which is slightly higher than industry peers. And post-expansion, we expect this ratio to increase to 3, which indicates high growth potential of the ES division. For the transactions analysis, we excluded 2 companies, namely EcoGlow, due to its relatively high EV to EBITDA ratio compared to the other transactions. And we also excluded the division of Tampwise because it specializes in HVAC EAS rather than smart lighting systems as an EAS. Now let's talk about the impact on the ESG consulting divisions. Here we also use a DCF because the cash flows for the ESG consulting is dependent on the number of new customers that the ES division brings in. So this approach best captures the incremental cash flows expected from the cross-selling opportunities. We applied the EV percentage of maintainable EBITDA based on normalized 2022 earnings to calculate the PV and to calculate the PV of the terminal values. The discount rate here is 2.5%, and we adding the incremental PV to the existing operations, we end up with a current value of about $33 million post-expansion. We've also factored in incremental capital expenditure equivalent to 0.75% of revenue to sustain ongoing operations. Now let's take a quick look at the term sheets. Focus on the impact of each term sheet on the equity value and the per share price. Post-expansion, Greenwave's EV is expected to be around $174 million. We then adjusted for redundant assets and the specific financing terms for each offer. For SCV's term sheet, added redundant assets, and then we subtracted the preferred equity, which is often viewed as debt. We then subtracted the PV of dividends payable to them, giving us an equity value of $106 million, implying a per share price of $8.59. This represents an upside of about 27% from the current share price of $6.77. In contrast, for William Wise, the term sheet involves convertible debt of $30 million. Here we also subtract the debt of $30 million, and we also subtract the PV of interest payments net of tax shield, giving us a much higher equity value of $140 million. Assuming William does not convert to common shares at the end of the 5 years, per share price will be worth about $11.34. If William does convert to equity at the end of 5 years, the per share price would be worth about $11.08, still representing an upside of about 64%. So here we can see that going with William definitely increases the share price by a lot more than going with SCV. And since IPOing is one of the long-term goals for Sarah and Jessica, this gives a higher chance of IPOing at a higher price. I'll now pass it on over to Ish, who will go over considerations for the term sheet.
Awesome. Thanks, Ansar. Now we'll talk about the term sheet for SCV specifically, and we'll look over at the pros and cons. So in terms of the pros, there is SCV can appoint a director who can bring new insights and professional experience to the board, and they can also provide Greenwave with access to their network. However, the drawback here is that they will have to remove the mutually appointed director to include this new director. And this Due to this heavy influence, this can cause conflict and potential decision-making moving forward. Another pro is that SCB really likes to sell itself on taking companies public and having successful IPOs, but considering that GreenWave is in the growth stage of things, this may not align with their short-term desires. Now, in terms of the cons, if we look at the dividend obligations, SCB can demand a share redemption as well as any unpaid dividends, which can strain the cash flows and reduce the usefulness of the debt that they're receiving. They're also, in terms of the sector-specific limitations, they do not have experience and lack experience in the ESG consulting and energy as a service industry. So when it comes to providing valuable insights, they could be limited in support here. Another thing to note is that they are entitled to 25% of voting rights. And we can see that on the impact of dilution, it is anywhere between 4 to 9% on common shareholders. Now, if we look at the second term sheet for William Wise, we can look at the pros and cons here as well. So in terms of the pros, they do have flexible financing structure with the convertible debt. So there's no immediate equity dilution. Also, William has relevant experience in this industry. So he can provide valuable insights that can move the decision-making forward of the company. Now, in terms of the cons, there is board influence as William can appoint a director. However, in comparison to SEV, we're not removing a mutually appointed director. We're simply adding another one. Another con would be the right of first refusal. As if you would want to sell your shares, you would need to reach out to William first, and he can purchase these at fair market value. The con here is that you're missing out on opportunities where investors are willing to pay fair market value plus any premium. However, if you want to sell your shares immediately, you do have a ready buyer. Now, if we look at the ownership impact, we can see that is anywhere between 3 to 7% on common shareholders. And if William does decide to convert his shares, he only has 19% stake in the company. Now I'll pass it on to Gabriel to talk about the cash flow forecast.
Thanks, Ish. So this cash flow forecast we prepared to demonstrate GreenWave's ability to meet the dividend and interest payment requirements. I mean, we can see that the $30 million injection in 2025 is sufficient to cover interest or dividends payable to SEV and William from 2025 to 2027, where the company is expected to realize some cash flow shortfalls. By 2028, the cash flows from operations are sufficient to cover either the dividend or interest payment requirements on their own. And by 2029, those cash flows jump significantly, at which point the firm can comfortably repay the $30 million principal if required. So we know that this expansion is feasible from a cash flow perspective, but now let's analyze some more risks. And I'll pass it off to Alex.
Thanks so much. So now to talk about the long-term risk faced by the current operations, we want to note that the strategic risks show that there's a high reliance on renewing their existing customers, and it's important to develop strategic plans to help manage the long-term growth with the service quality being maintained. To allow for the customers to gain the best quality possible and renew those GreenWave contracts, and to reduce liquidity concerns with 7 Wise's payments being 6 million and 7 million respectively, it's important to know that GreenWave moves over to growing its business. These risks are going to become much more apparent, and we urge management to plan contingencies to manage these risks and minimize them in the future. In conclusion, we at Insight believe that GreenWave should move forward with their plans to expand the EAS division, as it will provide a 68% upside from today's fair market value. Additionally, the convertible debt from William Wise will provide a strong liquidity to fund growth and manage interest payments commitments. And in year 5, if William does choose to convert, he will dilute all existing ownership from 3 to 7%. Additionally, some key considerations for the firm is that they should put their goals for an IPO post 5 to 7 years. This will help materialize the growth of the EAS division. The industry rule of thumb is a good indicator of the valuation methods for the quick industry analysis. Lastly, it's important to note that cross-selling of services and renewing of contracts is a key source of funding for GreenWave and must manage that with the high risk profile that GreenWave currently has. We would now like to open it up to any questions that you may have. Thank you.
Thank you for your presentation. I don't have a lot of questions. I'd just like to know how many hours we're going to bill the client for your presentation.
Well, what's your going rate? We got to base it on that. How much are they willing to pay us today?
Well, do you have an estimate of hours that you could provide?
I think at the end of the day, for us, we could estimate approximately 20 hours roughly, looking at how much we can value them and providing more in-depth analysis as well. We would like to spend some time, anywhere from 20 to 50 hours with them.
Okay, and is there anywhere you think your calculations are overly sensitive to assumptions that you've made in your analysis? Perhaps you
Yes,
can discuss
definitely.
that.
Yeah, I can get us started. And, looking back at the key assumptions that we've provided, the WACC calculation obviously is a key factor. Looking at the discounts that were provided, that can fluctuate sensitivity, whether you're moving it, and obviously the exit multiple as well. I'm also going to go back to our appendix slides to show you a better understanding of that. Right here. So when we're looking at the EAS expansion valuation, right, we look at all these different factors being a key factor, and EBIT, obviously the calculation with depreciation and the income tax, but also revenue being something that we've based off of the numbers that were provided to us. And hence everything is sensitive based on the WACC and the exit multiple that we have determined.
Okay, thank you for that.
I've got a question on the energy as a service business. Can you walk us through what you considered when selecting appropriate valuation approaches?
Yeah, I can take that one. Can you go to the sheet? So for the EAS division, we went with the DCF approach. So for the post-expansion, they have like they're getting customers at a different rate. So that means their revenue are not consistent over the first 5-6 years of the project. So that using the DCF helps us better captures those fluctuations in the cash flows. And then we have a terminal value as of 2031 when they reaches their maximum capacity. So for consistency, we also valued the current operations using a discounted cash flow just to make it easier and more comparable pre-expansion and post-expansion.
And for the pre-expansion on slide 3, was there any particular reason why you use the exit multiple and terminal growth methods, or?
Yeah, it's just to be consistent with a post-expansion valuation. So we don't want to use like different valuation approaches. So here we valued the the post-expansion valuation using DCF. So to be able to calculate the growth in the enterprise value, we believe it would be better for us to value the current operations using the DCF as well. So similar approach, 50% to the exit multiple, 50% to the terminal growth, just to make it easier to compare. And so we get the range of values instead of going with the capitalized earnings.
And what are the differences between the business in its current state and expansion?
So post-expansion, their main difference is their cost. I think actually it's in the appendix slides. If you just so right now they have already reached maximum capacity, and their cash flows are expected to grow consistently if they do not expand. If they do expand, they have an increased capacity. However, the number of new installations per year is not consistent. They don't just jump from like 30 installations to 90. It's gradual. So to be able to factor that change, that's why we use the DCF over like another approach.
Okay, thank you.
Great presentation. I just had a couple of questions. When you use the precedent transaction method, can you explain how you determined the set of comparable companies that you are relying on? I understand you do discuss why you excluded the two companies, but what were the factors that you considered when you determined that these 4 are comparable?
Yeah, for sure. So, the concept here is that we did want to look at the industry as a whole. Since this is based on the EAS division only, we focus on we looked at all of their businesses, and they do focus on the lighting businesses. Some do service commercial clients, some service smart clients with their smart technology, and then there is a mature client that does not have upfront costs at all. And these different factors are things that Greenwave is able to also consider in their current business model, right? Whether this was conversation that we wanted to have towards pivoting in the future, since they are still a growth stage company, these are options that they do have in order to, gain that business or improve that business. And hence the companies that are in front of you do give us that opportunity, and we do consider them on an industry level. And obviously looking at the companies that we didn't include, and that's mainly because they are not industry relevant. And obviously, as we spoke about, EcoGlow being at 100x valuation for their EV/EBITDA, it just did not align well with what the current operations are. And as you can see, the EV/EBITDA of the current operations for the comparables that we do have, they are very similar. They are between the 3.8 to the 5.3 range. We do take the 3.8, saying that is the lowest that's in the market right now, and just to pay that as a consideration versus taking out the 100x value and the business that's mainly focused on HVACs. It just does not align well with the current image of the EAS sector that we are currently operating in, and hence these four do help us kind of give that image.
Thank you. The other question I had, more so a recommendation than a question. If you go to your the discount rate analysis where you talk about the WACC, yeah. So I see that you're adding a factor of inflation to the WACC and then reducing the growth rate. So, just something to keep in mind. The WACC would, as such, already be inclusive of inflation, to say that it would be in nominal terms. So you wouldn't really need to add another inflation factor to it. Just something to keep in mind going forward. And another question I had was regarding the per share value under the two scenarios, the SEV funding and the William Wise funding. Can I just ask you, how did you calculate the present value of dividends paid to preferred equity holders at $40 million?
Yeah, I can take that one.
Sure.
So for the PV of dividends, we calculated the PV based on the WACC of 15%, and the dividends are expected to be 20% of the $30 million. So we assume they're based on the cash flow, they are going to be able to pay it every year. So we just calculated the PV of the $6 million every year, discounted by 15%.
Okay, all right. Thank you. Those are my questions.
Very good presentation. I have nothing critical to say. It's good job overall. And I do like your overall recommendation of delaying IPO so that we can get the ducks in order first. If we can go to slide number 8, page 8 of the presentation, where you did one above, page 7. Next page 7. Yes, I do like this page where you dissect the 3 different components. And you did touch on the goodwill being the biggest components of it all. Maybe just expand on this slide just a little, bring it a little bit further. Being a private company, given the level of goodwill and level of free cash flow, I want you to tell me how reasonable it is in terms of the goodwill you derived compared to the cash flow that we currently generate.
Sure, I can hop in and take this one. So I think in this scenario where we have a company whose value is based almost completely on their future cash flows, and they have a low tangible asset backing. I think that really that just implies greater risk. So those considerations are what we use to inform our WACC adjustments. And that risk is kind of baked into our analysis, but we do want to highlight that here just to show that high goodwill relates to higher risk.
Correct. So by extension, would that imply that on the EAS division where the expansion is considered, would you agree that the discount rate, because I understand the WACC is 15% across the board, correct me if I'm wrong. So let me know if, so do you think that 15% on both divisions, consulting and EAS with expansion, is appropriate, or do you think there should be a different risk factor or different discount rate for each division?
Sure. So just to address the first part of your question there, the ESG division has a specific WACC related to that. For the expansion, the ESG division is kind of contingent on that cross-selling ability and the synergies realized. So that expansion would have kind of a similar WACC related to it that we would apply to discount. When we used our analysis, we did perform some sensitivity related to the key drivers, and that includes WACC and the long-term growth rate. So for example, instead of our method of DCF was using the kind of two different approaches to get that range. Our sensitivity showed that if we were to apply a risk premium to the WACC in that scenario, we would end up with a kind of similar value on the low end, 130 million, which is comparable to the example method. So kind of just shows that there's two ways to the top of the mountain, and our low end of the valuation does consider that additional risk.
Very good. Yeah, overall, great analysis. The only suggestion that I may make on this slide is, being a private company, I would bring it further just to show how many years it would take for an investor to pay back the goodwill. So basically, the goodwill payback years would be a very enlightening calculation here. It's a very simple thing to do. Say, for instance, it takes 5 years to pay back the goodwill. I do enjoy the presentation overall. Very good job. Thank you.
Thank you. Great. If those are all of the questions from the judges, I'll ask you to return to your breakout rooms. Team 18, excellent presentation. Great work. You can now leave the meeting.
Great. Thank you so much.
Thank you so much for having us. Thank you.
What's the key to unlocking value in the business world?
For over 50 years, CBV Institute has set the standard for excellence in the business valuation profession. The CBV program of studies continues to be regarded as the gold standard in business valuation education, and our members remain highly respected and in demand throughout Canada and the rest of the world. By setting a high bar for our students, our members, and the business valuation community at large, we ensure the ongoing integrity and authority of the CBV designation. The status quo is never good enough, however. Through thought leadership, ongoing curriculum enhancements, and consultation with global regulators and standard setters, we make sure to stay at the forefront of industry developments and trends, keeping our members and students well positioned for continued leadership in the business valuation profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
The CBV designation is more than just a professional title. It's a gateway to a wealth of opportunities in the finance and business worlds. I'd like to elaborate on 5 of the key benefits that members tell us they enjoy as a result of being a CBV. 1. CBVs enjoy extremely diverse career opportunities. CBVs work in a wide range of areas, including corporate finance, transaction advisory, income tax and estate planning, litigation support, financial reporting, and much more. In short, CBVs are needed wherever and whenever an assessment of value is needed to drive a key business decision. 2, because of our high-quality education and professional standards, CBVs are highly sought after and have in-demand expertise. Demand for CBVs and CBV services has never been higher. CBVs are the go-to professionals when businesses or individuals need to understand value, and their skills are crucial in deal-making, litigation, and many other strategic decisions. 3, the CBV designation is respected worldwide, which opens doors to international opportunities, including working on cross-border projects or working overseas. Now, these 3 points taken together means that CBVs have extraordinary job security, which is extremely important in a constantly evolving economic and technological landscape. There will always be demand for valuation expertise. And of course, there are significant financial benefits to being a CBV. Most newly designated CBVs will enjoy a salary bump, and they often command starting salaries approaching or exceeding 6 figures. But most importantly, our members truly find value and have fun in their work, and they love what they do. They're at the forefront of financial market developments. They are leaders in finance and business, and they are constantly learning and adapting to interesting new challenges. As a CBV, you'll develop the unique ability to see what others might miss in the world of business. You'll uncover hidden value, navigate complex challenges, and make a real impact in organizations across a broad spectrum of industries. If you're ready to join a global community of valuation leaders and take your career to new heights, the CBV designation is your path forward. I invite you to embrace this transformative journey and discover the power of seeing beyond the numbers.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What's the key to unlocking value in the business world?
Becoming a CBV is a journey of personal and professional growth. The path to becoming a CBV is relatively straightforward. First, individuals must complete our globally respected program of studies, which delivers practical and relevant business valuation education. After completing the program of studies, the next milestone is the Membership Qualification Exam, or MQE. The MQE is a case-based 4-hour capstone exam, and it assesses your ability to respond to real-world situations that you may encounter as a practicing CBV. Individuals who pass the MQE are eligible to apply for membership. Before applying for membership, there are 2 more requirements. First, because practical experience is crucial in any profession, we require a minimum of 1,500 hours of business valuation or related experience. Because most individuals are working full-time as they work through the program of studies, they have earned their hours by the time they're ready to write the MQE. Secondly, individuals must have a 4-year degree from a recognized post-secondary institution. This means that university students can start the program of studies when they're still in school, but you do need your degree by the time you apply for membership. While a background or degree in finance or business is helpful as you move through the program of studies, it's not a requirement. Business valuation is a multifaceted profession that calls on a variety of skills and aptitudes, with an inquisitive mindset and excellent communication skills being high on the list. The journey to becoming a CBV is a rigorous path, but one that leads to immense opportunity and a rewarding career.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
Our globally respected CBV program of studies is the cornerstone of the CBV designation. It's designed to deliver practical, relevant business valuation education that places new CBVs at the forefront of business and finance. The program consists of 4 core courses that provide a robust foundation in valuation methodologies and real-world applications. Students also choose 2 out of 4 elective courses, which allows them to specialize in areas such as private investments, litigation support, corporate finance, or valuation for financial reporting, all incredibly important topics. What sets our program apart is its practical, market-driven curriculum. Our content is designed by CBVs for future CBVs, and it undergoes regular updates to reflect current best practices and relevant topics. This means our students are learning directly from industry leaders, and they're gaining knowledge and developing skills that are directly applicable in the workplace. We've built the program to be flexible and accessible. With online, self-paced learning, opportunities to connect with instructors and peers, and courses offered 3 times per year, students can complete the program while working full-time. Plus, all materials and exams are available in both English and French. It's a rigorous program that thoroughly prepares our students to excel as CBVs. Upon completion, they have the in-demand skills and knowledge to succeed in this dynamic, rewarding profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
Hi, everyone.
Hello and welcome, Team 26. Congrats on making it to the finals of BV Challenge 2024. We're excited to have you here presenting. All of the judges are here. So if you folks wanted to share your screen, you can get started whenever you're ready. Good luck.
Sounds great. Thank you.
Thank you.
Thank you.
Good afternoon. My name is John, and I'm joined with Danny, Xavier, and Vanny, and we are the associate team at Insights Valuations. Today, we will be presenting our analysis on GreenWave Solutions' existing divisions, future expansion opportunities, and dissecting the term sheets for the upcoming Series B round. We will begin with an executive summary to set the stage for our analysis. Next, we'll dive into our WACC calculation, valuation of GreenWave's current operations, and the expansion opportunity. We'll then summarize our valuation findings and discuss our analysis of the term sheets and wrap it all up with our recommendation and implementation strategy. Now, I'll pass it over to Vanny to provide an overview of our findings.
Thanks, John. Our objectives for this engagement were to 1, determine the fair market value of GreenWave's existing operations, 2, assess the value of the proposed EOS expansion, 3, analyze the impact of the 2 potential Series B term sheets, and 4, ultimately recommend the optimal funding option for GreenWave. We use discounted cash flow models, precedent transaction analysis, and multi-scenario analysis to determine that 1, GreenWave's ESG consulting division has a fair market value of $58 million, whereas the EOS division is valued at $60 million. The proposed EOS expansion has a total valuation of $158 million, and these fair market values represent significant growth from GreenWave's $25 million Series A valuation in December 2021. Ultimately, Term Sheet 2 offers the most favorable terms for GreenWave's growth, given its preservation of founder control, added EOS expertise to the board, and favorable cash flow impact. Next steps to implement our recommendations will include finalizing negotiations with William Wise for Term Sheet 2, developing a detailed capital allocation plan for the $30 million funding, and drawing targeted marketing strategies. Now, to inform and frame our analysis, we outlined GreenWave's priorities and market conditions. GreenWave's future hinges on 3 critical priorities. The first one being expanding the EOS division to capitalize on growing market demand. Secondly, balancing cash flow with growth investments to ensure financial stability. And third, preparing the path to an eventual IPO for improved shareholder liquidity. These priorities are shaped by key market insights, such as increasing competition in ESG consulting, rising popularity of EOS solutions, and 3, significant cross-selling potential between the ESG consulting clients and the EOS division expansion. Now, these factors are crucial for evaluating how each funding option aligns with GreenWave's growth strategy, supports financial stability, maintains control for the future IPO plans, and positions the company to leverage market opportunities.
Thank you, Vanny. We decided on different approaches for each of GreenWave's divisions, and GreenWave's EOS segment pre-expansion has an all-equity structure. We just used the cost of equity adjusted for inflation using the formula above to discount the cash flows for that segment. Given our term sheet recommendation, the WACC used to discount the forecasted free cash flows of the EOS expansion accounts for the increase in leverage. This WACC is also adjusted for both the inflation risk of 2.5% and the uncertainty risk of 3.7%, resulting in a WACC of 15.9%. The WACC used to discount the ESG consulting segment's projected cash flow also represents the segment's cost of equity adjusted for inflation. Should the segment be impacted by the increase in the company's debt structure, a WACC of 11.2% will be most appropriate to use then.
Thank you, Danny. We have prepared a DCF valuation for the ESG consulting division, which is experiencing strong growth and from rising demand of corporate ESG initiatives. Management has developed reasonable forecasts which help support this valuation method. A DCF model captures this division's future cash flow potential by using key assumptions and adjusting for irregular costs relating to GreenWave's integration challenges with EcoVision.
Discounting cash flows using our WACC provides realistic cash flow expectations, factoring in capital structure and industry risks. Key assumptions include a revenue growth rate that will stabilize at 4% by 2028, with cost of sales aligning with pre-acquisition figures and being further reduced by 5% due to synergies from the acquisition. Irregular marketing, legal, and transaction costs are not expected to continue moving forward. All of these inputs bring us to our EBITDA. We then make a normalizing adjustment to reflect the company's costs under normal market conditions. Crystal's salary is $100,000 above market, so we add back this net amount and deduct her earnout, calculated as 10% of normalized EBITDA exceeding $2 million for both 2023 and 24. For 23, this excess was $280,000. We then deduct income taxes at the corporate rate and net sustaining capital expenditures of $200,000 per year. We then add the tax shield from these expenditures at a Class 8 CCA rate and the accelerated investment incentive rate of 1 plus 1.5, as the half-year rule is currently suspended. We then apply our capitalization multiple to our terminal cash flow value using our WACC minus 4% growth rate, yielding our total discounted cash flows. We account for the tax shield on existing UCC allocated equally between the consulting and EOS divisions. Finally, we add redundant internally developed patents, which GreenWave does not intend to use. Therefore, the total fair market value of the ESG consulting division is $58.7 million.
Thank you, Xavier. For our primary analysis of the current EOS division, we decided to also leverage a DCF valuation. To frame the analysis, we expect the EOS division to maintain stable revenue growth, supported by consistent annual increases in subscription fees. Secondly, EOS companies are typically in growth phases, often reinvesting into infrastructure and technology to enhance long-term value. By using a DCF, we focus on the division's intrinsic value based on projected cash flows, ensuring that our valuation is grounded on actual business performance. For our key inputs and assumptions, we assume GreenWave operates at full capacity and does not increase its customer base significantly, which aligns with the division's current operational limits. Our model assumes both annual subscription fees and cost of revenues increasing by 2.5% per year, which is inflation adjusted. We also assume there won't be new sales and marketing expenditures, given they won't spend on acquiring new customers. Lastly, G&A and R&D costs increase as a percentage of revenue, remaining consistent with historical 3-year averages. This results in revenue growth from $33 million to nearly $37 million in 2029. After applying COGS and OPEX, it results in our EBITDA growing consistently from $3.6 million in 2025 to over $4 million by 2029, again, reinforcing the strong cash flow basis for our valuation. For our DCF, we began by calculating EBITDA and added back depreciation, which is estimated based on historical R&D expenses. Then we deducted $150K in sustaining capital expenditures and added a tax shield using the 20% Class 8 CCA rate and the accelerated investment incentive calculation. No additional normalization entries were needed, so we determined a capitalization multiple based on the WACC of 19.2% and then adjusted by a growth rate of 2.5%. This resulted in a terminal value of $100 million after applying the discounted cash flow values, the tax shield, and redundant assets. We reached a final enterprise value of $60 million. Overall, the EOS division has a higher valuation than the consulting division based purely on the DCF approach. We also leveraged a secondary valuation of precedent transactions to benchmark the EOS division's valuation by examining recent exits in comparable markets. This approach is valuable because it reflects actual market conditions and exit trends. We selected 6 comparable companies with transaction multiples that align with EOS's business model, growth in sustainable energy, and industry verticals. This valuation method allows us to derive a more market-oriented fair value for the division. When analyzing the precedents, we focus less on EV revenue because it's a good proxy for a company's revenue generation, but doesn't factor in costs, whereas EV EBITDA shows a strong representation of a company's health in generating operating cash flows and factoring in operating expenses, which is more important for EOS and smart lighting companies. For EV EBITDA, there's a skew in the mean multiple because of EcoGlow's higher transaction value of $127 million compared to its LTM EBITDA of $1.5 million. So we leveraged the median multiple of 2x since it better reflects the comparables, resulting in an EV of 81 million. We added this multiple into our valuation since it's a better proxy for the industry and comparable transactions as well. In summary, the total valuation of Greenway's current operations is $123 million. This is a $52 million increase up from the 71 million Series A post-money valuation. This reflects strong growth and market confidence in Greenway's business model. ESG consulting accounts for about 47%, and EOS represents about 52% of the total FMV. This near equal split highlights the importance of both divisions to Greenway's overall value. In terms of methodology, we place a greater emphasis on the DCF analysis across both divisions to account for the unique cash flow characteristics and long-term growth potential. However, there is a slight variation in approach. For the ESG consulting division, we relied exclusively on the DCF as it provides a detailed intrinsic value. For the EOS division, we took a blended approach, assigning a 80% weighting to DCF and a 20% weighting to precedent transactions. This weighting captures both the division's intrinsic value from future cash flows and market-driven insights from recent comparable transactions. We gave less emphasis to precedent multiples due to industry growth, market volatility, and the goal of reaching an IPO.
Thank you, John. As mentioned above, we chose a discounted cash flow analysis to find the fair market value of the expansion of EIS's expansion, given its limited amount of historical earnings as a relatively new segment of the company. The company's cash flows are also expected to fluctuate in the future as they acquire more customers before stabilizing once a max of 90 customers and 30 annual installations are achieved. We calculated our EBITDA using the expected revenues, cost of goods sold, and operating expenses, and added back depreciation. We removed income taxes as well as sustaining capex net of tax shield. And as we previously mentioned, our tax shield was calculated following the accelerated investment incentive rule. We projected financial year 2030 to calculate our terminal value because of the inconsistency in prior year forecasted-free cash flow growth rates. And we also determined that 2030 will be better reflect how the cash flows of the company will be in the future when a max of 90 customers is reached. We also accounted for the incremental revenues from ESG consulting as a result of the increase in total customers. We discounted our cash flows using our uncertainty risk-adjusted WACC and added back the tax shield impact on existing UCC. Finally, we subtracted the debt impact of our term sheet choice to derive a fair market value of 153 million, which is a 150% increase from the current EIS's operations. We used a multi-scenario analysis to support our valuation to estimate the fair market value of the expansion and reduce the potential bias in cash flow projections. The bull case assumes that EIS reaches 100% capacity with 90 customers in 2030. The base case assumes 75% capacity, while the bear case assumes 50% capacity. The DCF analysis was conducted similarly to the prior slide, including the net sustaining capex and incremental revenues from ESG consulting. The leveled WACC used was only adjusted for inflation, as the scenario weights covered their uncertainty risk. This resulted in a fair market value of 158 million, which is very close to 153 million from the prior analysis. A reasonability test based on a rule of thumb compares EIS's current EV per contract and EV to last 12-month installations against the market, and it shows an above-market performance pre-expansion and a similar market performance post-expansion. We also considered the limitations of our second evaluation analysis, because given the lack of background supporting the growth of customers each year, our assumptions limit the growth of the company up until 2030, and we acknowledge the fact that the company might continue to acquire more customers and not plateau after 2030.
We also analyzed the dilutive impact that each term sheet has. The current ownership structure sees Sarah and Jessica holding 48% total ownership. Term sheet 1 implies immediate dilution to all existing shareholders, dragging the founders' combined share to 36%. Earthwise's stake would be diluted by 9%, losing their ability to appoint directors, making this alternative unfavorable to their interests. Term sheet 2 sees a delayed dilution effect, as dilution only occurs when the debt is converted. If debt were to be converted in 5 years, assuming all other ownership stays the same, the founders' combined share would be 38%, 2% higher than term sheet 1. Earthwise's share is only reduced by 7%, leaving them and the founders with 66% of the voting shares and therefore total control. We recommend term sheet 2 from this perspective, as dilution is delayed and control is maintained. Term sheet 1 comes with an annual cumulative dividend of 20% on the face value of the shares. This implies a total annual dividend of $6 million. And according to market research, average dividend yields for preferred shares are only around 5 to 8%, making this yield extremely high. A key criteria for term sheet 1 is that if the full amount of dividends are not paid for 3 consecutive years, SEV will retract their investment. Given the retained earnings role on projected net income, they will not be able to pay this dividend from 2026 to 28. Therefore, this option is not viable. The impact of the interest expense from the debt of term sheet 2 leads to a reduction in cash flows. However, the 8% interest rate compared to the 20% dividend rate means more cash on hand internally for GreenWave to reinvest back into the company. Financially, we recommend term sheet 2.
Looking at the term sheets qualitatively, we continue to recommend term sheet 2 as it supports GreenWave's growth strategy with minimal impact on the existing shareholder agreement. This term sheet expands the current 5-member board to 6 members by adding William's seat, preserving founder influence while leveraging William's connections and EOS expertise to boost customer acquisition and facilitating introductions to future investors. Although there are concerns about cash flow strain due to interest payments and potential complications in future funding should the convertible debt be converted, projected revenue and EBITDA growth should mitigate these risks effectively. Moreover, the 8% interest payments also provide a tax shield, enhancing after-tax cash flows by reducing business income by the interest amount. Now, while term sheet 1 looks attractive, given SEV's equity vested interest and a strong track record of IPO successes, we do not recommend it, as SEV's replacement of an appointed director reduces founder representation from 3 to 2 seats. Additionally, the 20% cumulative dividend will limit cash flow for reinvestment. Lastly, SEV's lack of ESG experience may hinder GreenWave's competitive edge. Ultimately, we do not recommend pursuing term sheet 1. In summary, term sheet 2 aligns best with GreenWave's growth objectives, providing less dilution and a more positive cash flow impact while offering strategic support, preserving founder control for future growth in the EOS industry. Now, to ensure a successful Series B funding round, our implementation strategy includes finalizing the term sheet negotiations, planning the capital allocation of the $30 million, and investing in targeted marketing strategies. First, GreenWave must negotiate favorable terms with William Wise to promote financial discipline and allow room for growth, ensuring adequate cash flows and effective risk management. Terms to negotiate with William include flexible capital expenditure limits to grow spending in line with revenue, negotiating the number of shares for conversion at the end of the convertible debt's maturity, and a risk-adjusted interest rate closer to the 5-year Treasury rate with a reasonable risk premium. Next, given the higher risk of debt, GreenWave should focus on investing its $30 million in funding on acquiring property, plant, and equipment to grow EOS capacity from 5 to 30 installations annually by 2029, and remaining funding should be allocated on customer acquisition and research and development to refine the EOS offerings. Lastly, a strong marketing strategy can drive demand for GreenWave services in line with regulatory changes favoring sustainable operations due to Scope 1, 2, and 3 requirements in multiple industries. Investments in account-based marketing, thought leadership, and a referral-based program will ensure optimal utilization of the increased installation capacity while facilitating cross-selling opportunities with existing ESG consulting clients. In conclusion, this 3-part strategy positions GreenWave to capitalize on the projected $153.2 million value from the EOS expansion. Thank you for your attention. We are excited about GreenWave's continued success and are here to support them throughout the journey. We now welcome any questions and feedback.
Hey everyone. I think it was a great presentation. A couple of questions that I had. First one being regarding the analysis of the term sheets. I'll just tell you what slide that was on. Just give me a moment. Yeah. On slide number 14. So at the bottom right, you say, bottom left, you say that the debt covenants may conflict with current shareholders agreement. I was just curious as to, how, in what way would the covenants conflict with the shareholders agreement, and what was the thought process behind this?
Yeah, thank you for your question. I can go ahead and answer this one. So in terms of the debt covenants, currently in the term sheet, there are no debt covenants that are outlined. So rather we put this statement that debt covenants may conflict with current shareholder agreements as kind of more of a cautionary note for GreenWave. So given that there is this risk of confliction, in our three-part implementation strategy, we really encourage negotiate with William Wise to prevent this from happening. And some debt covenants to discuss with him would include a flexible capital expenditure limit, as well as also discussing other covenants that he may have in mind, such as perhaps like a times interest expense ratio, to make sure that those ones will ensure discipline on GreenWave's side, while also ensuring that it doesn't constrain their growth, spending, and operations. So it was more of a cautionary note.
Thank you. The other question that I had was, in your present and transaction analysis, was there any qualitative analysis performed when relying on these companies as comparables? I understand that you exclude EcoGlow because of it being an outlier due to quantitative factors, but what kind of qualitative analysis did we do to, identify whether these companies are comparable to the EAS division?
Yep, absolutely. Thank you for your question. So there were numerous qualitative factors that we put into consideration. The first one was the timeline. So when looking at precedent transactions, you want to have the more relevant and more recent sort of comparables, as it's a good reflection of sort of market trends currently happening and sort of the demand of investor behavior and also strategic investors in sort of acquiring more EOS division companies. Another factor was actually looking at their business model. So within all these comparable companies, they were all under sort of the EOS service line, or they had smart lighting capabilities. So we felt that these were comparable transactions to sort of what sort of GreenWave is currently doing with their EOS division. Also, we also looked at sort of like different EBITDA and also revenue multiples as well, looking at sort of the size of how much they're actually making. So let's take EcoGlow, for example. They were making about a lot less revenue compared to these other companies, where they were actually more of a seed stage company. So that's why their multiple is a lot higher. It resulted in sort of a higher transaction value compared to sort of revenue and also their EBITDA, whereas the other ones were more in a later stage, so more Series B, C, and plus. So those are some of the qualitative factors that we considered for the precedence transactions.
Thank you. One last question that I had was on the WACC analysis on slide 5. I see that you've added an uncertainty risk premium of 3.7% to the WACC. So I have two questions around that. One being, how did we determine this factor? And why is it equal for the EAS division and the ESG consulting division?
Yeah, absolutely. I can take on that question. So the 3.7% that we used was the risk-free rate based on a 5-year average. That is the value that we use based on what was required in the case. And in terms of why we added in, we assumed that given that this was a valuation that was made based on projected values, there was still an uncertainty that those cash flows might not be achieved by GreenWave. So we decided to add that uncertainty risk to our WACC to increase the discount rate to account for the additional risk of the projected cash flows not being achieved in the future. And in terms of why it's the same for the EAS and the ESG consulting, we use the risk-free rate, which is overall the rate that an investor expects from a risk-free asset. And we use that rate both for EAS and ESG consulting because it's the most generally accepted and available rate that can be used for any risk-free asset available. Does that answer your question?
Yeah, thank you.
I've got a few questions, but firstly, just wanted to, congratulate you on a great presentation and, just the layout of the slides. I think you did a good job in laying out the slides for us. I guess just one point to make on the precedent transaction slide. I just noticed when the multiples were calculated, they're just calculated off of the transaction value. So we just need to also consider debt for enterprise value because it will influence your conclusions. And then I think I would also like to kind of get your thoughts as well on, when you did your analysis and, you've calculated implied values, how did you compare that to the transaction multiples just to, be able to assess reasonability? If you could get your thoughts on that.
Yep, for sure. So correct. The reason why we didn't include debt within our multiple was because sort of currently within GreenWave's current operations, they don't actually have any debt in their operations. So we felt like it would be a good primer to sort of not include that in the multiple. But to sort of answer your second question, we wanted to really analyze sort of recent transactions that could sort of have a good proxy of where they could exit at. Also considering that they don't really plan on getting acquired or either spinning out one of their divisions, we put less weighting on sort of the valuation of the actual president's transactions, because really the ultimate goal is sort of diving deeper into sort of the EOS division is to sort of bring it to IPO along with the ESG consulting division. Yeah, can I expand on sort of my answer? Does that sort of answer your question?
I think if you have anything further to add, please share.
Yeah, for sure. And then sort of just like sort of additional research that we've sort of done to sort of understand the whole market size of EOS as well. So we leveraged sort of market research reports to sort of understand if it was sort of worth sort of pursuing the EOS division a little bit further. So we got the sort of global total addressable market of EOS and got it of around $75 billion and with a CAGR of about 10%. So we really think there's some upside to sort of pursuing the EOS division a little bit further, thus also putting less weighting on the president's transactions, but we sort of want to use it as a proxy on how they could sort of exit at a relative valuation. And then also on the flip side for sort of ESG consulting, we also thought that there's a huge market size with about $13 billion in total addressable market globally with a CAGR of about 26%. So we really think that combining both sort of divisions within our analysis and pursuing both opportunities would really present a great opportunity for GreenWave to expand their business operations.
Thank you. I've got another question as well, just with respect to any other research that you did as part of this work. You mentioned earlier that you did some work on preferred dividend rates. Could you elaborate a little bit more on that? And then if there's any other research that you did and you'd like to share, we'd like to hear about that as well.
Yeah, for sure. So basically, when looking at these term sheets, especially term sheet 1, knowing that there's going to be such a financial impact, knowing that the dividends are going to have to be paid out every year consecutively for 3 years, we wanted to make sure that we knew exactly what the dividend value was going in ahead, and then of course doing the retained earnings roll to see if we'd actually be able to pay out this dividend. So knowing that we've knowing that the general market rate for preferred dividend yields is around 5 to 8%. This just highlights how extreme and how significantly high that this 20% dividend yield is, especially for a company that's trying to go an IPO. They're going to be spending so much of their money on their dividends that they're going to have less money left over to reinvest back into growth and reinvest back into the business. So understanding, current dividend yields in the market is important to be able to understand that this is not a risk that is worth taking, especially when knowing that if the dividend payments do not go through, then the investment will be retracted, which is exactly the opposite of what GreenWave wants. Does that answer your question about the dividend yield?
I guess I was just curious, what research did you do to, again, determine that a rate of 5% was reasonable? Because you'd mentioned that you did some research.
Yeah, so sort of just looking at, similar companies in the energy and utilities industry, seeing that those companies usually do have higher paying dividends, and then sort of looking at comparables within the market to understand, their dividend yields, and then also taking a general market approach to just sort of all preferred dividends as a whole. So, what rates are on dividend yields are actually being presented to investors.
And then my last question is on the valuation approach. Just curious, did you consider any other valuation approaches in valuing the service business? Was there anything else that you considered when you selected the valuation approach that you selected?
For
Yeah.
sure. Oh yeah, go ahead, Danny.
Oh, okay, sounds good. Yeah, I can take that on. When valuing the ESG consulting business, we also thought about the capitalization approach, where they will value the capitalized cash flows. However, we saw that didn't really fit the current situation of GreenWave, given that they are more of a new company and they don't really have stable cash flows. So we kind of just settled on a DCF analysis for that valuation.
Yeah, and just to add on to that, so for the EOS division specifically for the service line, there's also the possibility of looking into broadly comparable companies as a whole. But given the fact that we're looking at expanding this company into an IPO, we want pure intrinsic valuation on exactly what this company is going to be able to offer investors in terms of cash flow for the future. So we believe that the DCF valuation really captures that, as well as it makes sure that the investors know in the future what cash flows that the company will be able to generate based on purely intrinsic in company numbers and figures.
Thank you.
I have a question.
Michael, did you want to go?
You can go. Go ahead and I'll go after you.
Very nice presentation. I really enjoyed it. Good color scheme and the gradients make it very appealing. Can we go to slide number 9? Yes, so I'm looking at this DCF approach. So we started with EBITDA of 3.5 to 4.1 million from 2025 to 2029. We deduct taxes and we got to operating income 2.6 to 3 million. And then we deducted capex. We added back the non-capital losses available to deduct against income, and we added back tax shield. But I couldn't reconcile how did we get to the after-tax cash flow of 7 million? Can you just elaborate on that part?
Yeah, so I could handle that one. So we started off with the EBITDA, and then we sort of added on, so deducted sort of the income taxes to get our net operating income. So our tax shield was calculated using sort of the accelerated investment incentive sort of calculation. So since there wasn't any half-year rule, we used a 1 plus 1.5 sort of calculation to expand. But Xavier could expand a little bit deeper into sort of like the evaluation and sort of the expansion of these cash flows.
Right. Thank you. Essentially, yeah, we're going off of the EBITDA and then going into the net operating income numbers. And then in terms of getting to the adjusted after-tax cash flow, this is sort of coming from just the net operating income amount uh, being taken after we've taken off the tax shield and added in the non-capital losses as well.
Right. Would so with the exception of 2025, which is a special year where we added back the non-cap losses, wouldn't the after-tax cash flow be less than my operating income? Or is there explanation why we have more cash flow than we had the income?
Yeah. So for sort of it's higher because we believe that the non-capital loss is actually an asset, which will sort of offset any losses as well. So we felt like adding it back to sort of the after-tax cash flows will sort of represent sort of the enterprise value and sort of the actual value of sort of having that little tax asset as well.
Right. Okay. Understood. Can we next go to slide number 13? I do like you had a scenario-based analysis, a base, a bull, and bear. Kudos on that. It does sort of provides a sensitivity or different scenarios when you think about what can actually be achieved in the forecast. So I do enjoy having 3 scenarios. I'm wondering that given that these scenarios obviously carry different levels of risk, being it's easier to achieve the bear than achieve the bull. I'm wondering, how did you factor in any kind of risk analysis when you're discounting that future cash flow in these 3 scenarios, or did you use a uniform discount rate on all these 3 scenarios?
Yes, I can take that on. A uniform discount rate was used to discount all of the 3 different scenarios, and that's because we mainly wanted to put in the way, given the projected cash flows developed by the independent firm, we saw that they assumed that Greenwave will be able to achieve a max of 90 customers, so they would have enough data to back their assumptions up. So our differences were mainly shown through the weightings, the different weightings of each of the cases to overall factor in the uncertainty of each.
Understood. That's also a good approach. That's all my questions. Thank you. Very good presentation.
Thank you.
Thank you.
Guess I'm last. Okay, so we met yesterday afternoon, and my fellow partners weren't with me, and then I went home and enjoyed my evening. I'm just wondering what changes you made to the deck and why.
I can go ahead. One of the primary changes that we made to the deck was with regards with the implementation strategy. So we found that there was an opportunity to further refine our implementation to make it more detailed and therefore more actionable. One of the main updates that we made to this deck was with regards with the term sheet negotiations. So we specified 3 key points that Greenwave could bring, that Greenwave can bring to the table when they're discussing with William Wise. And we've chosen these key points of negotiation, so being the flexible capital expenditure limit, conversion rate, and the risk-free interest rate, based off of the growth strategy that Greenwave is aiming for. So hence the flexible capital expenditure limit. Greenwave will expect to allocate the 30 million to expand. So if there's a limit on how much they can spend, that could also limit the number of installations they will achieve, and therefore the revenue, because the number of customers they can accommodate will decrease. As well, we wanted to also include the conversion rate, because currently the 30 million in convertible debt is convertible to, I believe it was 3 million shares, but we wanted to negotiate this 3 million shares to do it based off of Greenwave's future performance. Should they be really successful in the future, this number should accommodate that change in performance rather than setting the conversion rate ahead of time. And then lastly, the risk adjusted rate for the interest rate. So it's currently 8% on the term sheet, but we found that 8% was rather high compared to the 5-year Treasury bond rate of 3.7%. Now we understand there is an opportunity, or there is rather some risk premium that should be taken into consideration rather than just pitching the 3.7%. So we put that there as well, risk adjusted interest rate. So that was one of the primary changes that we made to the deck for the implementation slide. And there are other changes that my colleagues could speak on as well.
Yep, I could sort of add a little note as well. So for sort of our overall valuation of sort of GreenWave as for the current division, we split the weighting a little bit differently for sort of the EOS division. We used to have a higher weighting on we used to have a lower weighting on sort of the DCF and then a little bit of a higher weighting on the president transactions. But we decided to sort of have more weighting on the DCF, again, to sort of better reflect the intrinsic value, and also considering that they're likely going not to sort of exit on an acquisition or a merger, we decided to put a little bit less weighting as well there.
Thank you for that. Glad to see you working hard over the evening.
Thank you.
Okay, if that is all the questions from the judges, then judges, you can return to the breakout room and deliberate. Team 26, excellent job, great presentation. And make sure you tune into the finals announcement or the awards announcement at 7:30.
Thank you very much for
Thank
your
you.
time. Thanks, everybody.
What's the key to unlocking value in the business world?
For over 50 years, CBV Institute has set the standard for excellence in the business valuation profession. The CBV program of studies continues to be regarded as the gold standard in business valuation education, and our members remain highly respected and in demand throughout Canada and the rest of the world. By setting a high bar for our students, our members, and the business valuation community at large, we ensure the ongoing integrity and authority of the CBV designation. The status quo is never good enough, however. Through thought leadership, ongoing curriculum enhancements, and consultation with global regulators and standard setters, we make sure to stay at the forefront of industry developments and trends, keeping our members and students well positioned for continued leadership in the business valuation profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
The CBV designation is more than just a professional title. It's a gateway to a wealth of opportunities in the finance and business worlds. I'd like to elaborate on 5 of the key benefits that members tell us they enjoy as a result of being a CBV. 1, CBVs enjoy extremely diverse career opportunities. CBVs work in a wide range of areas, including corporate finance, transaction advisory, income tax and estate planning, litigation support, financial reporting, and much more. In short, CBVs are needed wherever and whenever an assessment of value is needed to drive a key business decision. 2, because of our high-quality education and professional standards, CBVs are highly sought after and have in-demand expertise. Demand for CBVs and CBV services has never been higher. CBVs are the go-to professionals when businesses or individuals need to understand value. and their skills are crucial in deal making, litigation, and many other strategic decisions. 3. The CBV designation is respected worldwide, which opens doors to international opportunities, including working on cross-border projects or working overseas. Now, these 3 points taken together means that CBVs have extraordinary job security, which is extremely important in a constantly evolving economic and technological landscape. There will always be demand for valuation expertise. And of course, there are significant financial benefits to being a CBV. Most newly designated CBVs will enjoy a salary bump, and they often command starting salaries approaching or exceeding 6 figures. But most importantly, our members truly find value and have fun in their work, and they love what they do. They're at the forefront of financial market developments. They are leaders in finance and business, and they are constantly learning and adapting to interesting new challenges. As a CBV, you'll develop the unique ability to see what others might miss in the world of business. You'll uncover hidden value, navigate complex challenges, and make a real impact in organizations across a broad spectrum of industries. If you're ready to join a global community of valuation leaders and take your career to new heights, the CBV designation is your path forward. I invite you to embrace this transformative journey and discover the power of seeing beyond the numbers.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What's the key to unlocking value in the business world?
Becoming a CBV is a journey of personal and professional growth. The path to becoming a CBV is relatively straightforward. First, individuals must complete our globally respected program of studies, which delivers practical and relevant business valuation education. After completing the program of studies, the next milestone is the Membership Qualification Exam, or MQE. The MQE is a case-based 4-hour capstone exam, and it assesses your ability to respond to real-world situations that you may encounter as a practicing CBV. Individuals who pass the MQE are eligible to apply for membership. Before applying for membership, there are 2 more requirements. First, because practical experience is crucial in any profession, we require a minimum of 1,500 hours of business valuation or related experience. Because most individuals are working full-time as they work through the program of studies, they have earned their hours by the time they're ready to write the MQE. Secondly, individuals must have a 4-year degree from a recognized post-secondary institution. This means that university students can start the program of studies when they're still in school, but you do need your degree by the time you apply for membership. While a background or degree in finance or business is helpful as you move through the program of studies, it's not a requirement. Business valuation is a multifaceted profession that calls on a variety of skills and aptitudes, with an inquisitive mindset and excellent communication skills being high on the list. The journey to becoming a CBV is a rigorous path, but one that leads to immense opportunity and a rewarding career.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
Our globally respected CBV program of studies is the cornerstone of the CBV designation. It's designed to deliver practical, relevant business valuation education that places new CBVs at the forefront of business and finance. The program consists of 4 core courses that provide a robust foundation in valuation methodologies and real-world applications. Students also choose 2 out of 4 elective courses, which allows them to specialize in areas such as private investments, litigation support, corporate finance, or valuation for financial reporting, all incredibly important topics. What sets our program apart is its practical, market-driven curriculum. Our content is designed by CBVs for future CBVs, and it undergoes regular updates to reflect current best practices and relevant topics. This means our students are learning directly from industry leaders, and they're gaining knowledge and developing skills that are directly applicable in the workplace. We've built the program to be flexible and accessible. With online, self-paced learning, opportunities to connect with instructors and peers, and courses offered 3 times per year, students can complete the program while working full-time. Plus, all materials and exams are available in both English and French. It's a rigorous program that thoroughly prepares our students to excel as CBVs. Upon completion, they have the in-demand skills and knowledge to succeed in this dynamic, rewarding profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
Can anyone hear me? Or I don't hear any sound, I think.
I could hear you.
Okay, perfect. Okay. Can we just start whenever?
All right. Yeah, you guys can start whenever you're ready. Good luck, you guys.
Awesome, thank you. So hello team, thank you all for taking the time to meet with us today. My name is Dennis and I'm joined by my fellow associates Jackie, Vanch, and Ben here at Insight Valuations. Today we put together a preliminary memo for our client Greenwave Solutions as you requested. Without further ado, let's jump right in. So to give you an idea of what we'll be covering over the next 15 minutes, here's our table of contents. After our executive summary, we'll discuss the valuation of the current operations compared to our operations with the EAS expansion. We'll then discuss the two different term sheets on the table and then give a recommendation on which to proceed with. From there, we'll wrap it up and answer any questions you may have. So our objective for today is to help Sarah and Jessica determine if it's worthwhile to pursue an expansion of Greenwave's EAS division and advise them on the optimal Series B funding route to do so. As such, you have asked us for the following deliverables. 1, calculate the fair market value of the existing operations. 2, calculate the fair market value of the proposed EAS expansion and comment on whether or not to proceed. 3, compare the two term sheets proposed. And 4, provide a recommendation on which of these two term sheets Sarah and Jessica should proceed with. To calculate the fair market value of the existing operations and the EAS expansion, we used an income-based intrinsic approach, coming to an $80 million EV pre-expansion and $443 million post-expansion. Additionally, we blended in the use of a relative valuation approach for the fair market value of the existing operations. Now, you might be wondering why we opted out of the use of other methods like the capitalized cash flows, or in the case of the EAS division, EV to total number of contracts and new installations. This is more so because we took a VC-centric approach, given that this is a Series B raise. We know that VCs primarily value revenue growth, and thus we were more focused on the revenue growth potential for Greenwave in both the no raise and the EAS expansion case. Now, giving the intrinsic valuation a weight of 70% and the relative valuation 30%, we came to a blended EV of $74 million for Greenwave's existing operations. Compared to our fair market value post-expansion, this represents a significant upside, and thus we do recommend to proceed with the EAS expansion. Now, the reason we place a higher emphasis on intrinsic valuation is because it's forward-looking and accounts for future growth, whereas relative valuation is backwards-looking. Additionally, comparable public EAS companies were few and far between for us to come across. However, we still incorporated relative valuation because we believe it's important to factor in some degree of market sentiment. Now, one very key differentiation to our approach is that we used a different WACC in our expansion scenario. I'm going to repeat this. We used a different WACC in our expansion scenario by baking in the impact of the term sheet that we will be proceeding with to fund that expansion. When comparing the two term sheets to determine how the expansion should be funded, we primarily assessed each party's portfolio synergies with their past investments, as well as how founder-friendly each term sheet was with regards to raising future funding rounds. Given our analysis, we ultimately advised Sarah and Jessica to proceed with the EAS expansion funded by William Wise's Series B offer. Now, let's kick off with our valuation of Greenwave's operations pre-EAS expansion.
Perfect. So starting off with the fair market value of Greenwave's operations, we first ran a DCF model on the consulting division, which gave us an implied EV of $35.9 million, as seen at the bottom right. Looking back at the left side of the slide at our DCF, we've forecasted revenue growth to be consistent with the long-term industry growth rate at 4%, while gross margins forecasted based on fiscal year 21's gross margin of 35%, plus a 5% synergy with the completed integration of EcoVision. We've also reflected earnout costs of $18 million in fiscal year 2025 to reflect Crystal's payout for the division's performance in fiscal year 22 and 23. This is the only non-recurring expense that we've reflected in our EBITDA margins, as we have adjusted out every other cost from both our 2024 numbers and our forecast numbers as well. As for sales and marketing, we expect to be consistent with fiscal year 22 and 23 at 5%, reflecting a normalization from fiscal year 24's temporary increase. As for G&A, we expect it to remain a consistent percentage of revenue, reflecting an average of the past 3 years, representing the service-based model of the division. Moving on to our discount rate in the top right, we applied an illiquidity risk premium of 3% to the cost of equity, primarily reflecting the division's limited liquidity, while also accounting for its profitability and more established history. This ultimately gave us a WACC of 15.7%. When discounting our projected cash flows and applying an exit revenue multiple of 1x, which is a conservative view based on our peer comps, we arrived at the implied enterprise value of $35.9 million, as seen in the bottom right. Our reason behind using an exit multiple approach is because we believe it aligns with the founder's intention to pursue an IPO in the future and offers the most accurate representation of the company's potential value if they were to go public by incorporating current market sentiment and valuations. We believe it better reflects how public market investors would value the company during an IPO, and it's important to note that this valuation is particularly sensitive to the exit multiple, with a change of 0.5 times impacting the division's value by roughly 23% in either direction. Moving on to our valuation for the ES division, we employed a similar approach, which gave us an implied EV of 44.8 million, as seen in the bottom right. Going back to our assumptions in the DCF on the left side, we forecasted expenses to stay at a consistent percentage of revenue as the ES division remains capped at 15 customers, with little room for margin appreciation as subscription fees increase at the same rate as the cost of revenue, and as the company demonstrates limited operating leverage due to its capped growth. Like with the consulting division, we have adjusted out every non-recurring expense in our EBITDA figure. As for income taxes, we forecasted them to be 0 in 2024 and 2025 as the company utilizes its non-capital losses of $2 million from previous years. Moving on to our discount rate in the top right, we added an illiquidity risk premium of 4.5% at the higher bound of VC standard ranges. This higher premium reflects the division's nascency, history of loss making, and lower growth potential given the current state of it, which gives us a WACC of 17.3%. When applying this WACC to our future free cash flows and applying an exit revenue multiple of 2.5 times, we arrive at the implied EV of 44.8 million for the ES division. This exit multiple primarily reflects the current valuation of our public market comparable ES companies, and similar to the consulting division, a 0.5 times change in the exit multiple can result in the value increasing or decreasing by 19%. Combine this with the consulting division EV, and we arrive at a total implied EV of 80.7 million. When applying this, when applying this WACC to our future free cash flows, it gives an implied EV of 80.7 million. Moving on to our relative valuation, we screen for both ESG consulting and ES companies to ensure a comprehensive comparison. For ESG consulting, we identify key comparables such as Tetra Tech and Arcadis in our ESG consulting screen, as seen in the bottom left. For ES companies, we found Amerisico and Bloom Energy as displayed in the middle right. We then applied the average trailing 12-month multiple to each division's revenue, then weighted by GreenWave's current revenue breakdown. This approach yielded a valuation of 70 million for GreenWave, which aligns well with our DCF valuation. And we believe that this consistency across different valuation methodologies reinforces our confidence in our overall estimate. Now, moving on to the Series A valuation versus the fair market value of current operations, we first backsolved for the Series A pre-money valuation using the round size and Earthwise's ownership percentage. This gave us an implied pre-money valuation of 46.4 million. As for the fair market value of GreenWave's current operations, we weighed our DCF valuation 70% and relative valuation 30%, as Dennis mentioned in the exec summary, giving us a blended EV of 77.5 million. As you can see, over the past 3 years, GreenWave has been able to grow its EV by over 30 million, or roughly 67%. As mentioned before, the reason why we weighed our intrinsic valuation more is because we wanted our valuation to reflect a more forward-looking view of the company's potential, but we also wanted to account for the current public market sentiment and assess how much value the public markets might assign to GreenWave. Additionally, as seen on the previous slide, there are a few publicly traded ES companies that could provide a meaningful comparison to our intrinsic valuation. However, it does seem that investors are willing to value this company higher, as my colleague Vanch will present in the next section.
Now, as Jackie has illustrated the current fair market value of GreenWave's operations, we have also conducted an analysis on the valuation of the company with the ES expansion and how it will support the anticipated capital raise and investment through the Series B round. Using a discounted cash flow model analysis, we arrived at an implied enterprise value of 389.5 million for GreenWave, an impressive over 700% increase over the current implied value, highlighted on the bottom right of your screen. The revised DCF differs from the previous one in 5 key areas, the most significant being revenue growth. With GreenWave's ES division accelerating its expansion, a larger customer base is now achievable, allowing for higher growth potential over the next 5 years, unlike when the division could only support a limited number of clients. We're projecting short-term compression in EBITDA margins from 2026 to 2027, and this is due to rising installation costs and customer acquisition costs. However, margins are expected to recover and improve again by 2028. In terms of our weighted average cost of capital, as Dennis mentioned, we use the second term sheet as a basis, factoring the 30 million 8% convertible note. We updated Greenwave's weight of debt to 77% and the cost of debt to 6.5%. This shift in capital structure with a higher weighting of debt reduces the WACC from 15.7% to 11.3% for the EAS division. Applying this new WACC to our projected free cash flows, along with an exit revenue multiple of 2.5x, we reach an updated implied enterprise value of 387 million for Greenwave's EAS division. Even with using our more expensive previous WACC, we would still come to an enterprise value of 300 million, which is still 500% above the previous value. Moving on to the impact of the ES expansion will have on Greenwave's ESG consulting division, we see that the only major key difference is the increase to revenue growth rate, which is contributed by the synergies with the ES division expansion. Applying the previous weighted average cost of capital to our projected free cash flows, along with an exit revenue multiple of 1.0x, we reach an updated implied enterprise value of 56.3 million for Greenwave's ESG division, which is a 56.9% increase. To summarize our findings, on the left, we see the consulting division where the implied enterprise value increases from 35.9 million pre-expansion to 56.3 million post-expansion, representing a 56.9 uplift in value. On the right, we have the ES division. Here, the implied enterprise value jumps from 44.8 million pre-expansion to 389.5 million post-expansion, a significant 769%. Overall, the expansion positively impacts both divisions, with the ES division seeing substantial growth at the rate that exceeds the WACC. This supports the recommendation to proceed with the ES expansion, and now I'll be passing it to Ben, who will be conducting discussion on the term sheets presented to Greenwave.
Thank you, Vanch. Now let's analyze each term sheet. First, we analyze the current effect each term sheet would have on fully diluted ownership. On the left, you could see the distribution of ownership pre-Series B. Now, with Sustainable Edge Ventures investment of $30 million for preferred shares with a requirement of 25% of voting rights, you could see on the right, post-Series B, Sarah and Jessica's ownership drops to 18% each. On the other hand, William Wise's $30 million investment of convertible debt, which he could convert into 3 million shares at a maturity, will leave Sarah and Jessica with 19.3% ownership each. Based only on this analysis, William's term sheet is more favorable to Sarah and Jessica, as they'll only have to give up 4.7% each in fully diluted ownership, compared to 6% if they were to go with Sustainable Edge Ventures. Next, we analyze the implications of each term sheet. First, let's look at Sustainable Edge Ventures terms. At a high level, the most significant items are 1. SEV initially wants 25% of the voting rights. 2. They're required to be issued cumulative dividend preferred shares, which could be immediately retractable at face value, plus outstanding dividends if the dividends have not been paid for 3 consecutive years. 3. They'll replace Sarah and Jessica's joint appointment to the board. And 4. They require anti-dilution rights, which activate if their voting interest decreases below 20% and cease once they've reached 25%. Now, the pros of accepting SEV's investment is that they have advisors that could support Greenwave's business development and have connections with other investors, and also have a track record of 10% of their investments having IPO'd and are still operating. This aligns with Sarah and Jessica's long-term goals. But the cons of accepting Sev's offer is that 1, they have no track record of working with investments in Greenwave's industry, and 2, have founder-unfriendly terms, as they require Greenwave to issue a new share class and a provision for anti-dilution. This doesn't align with Greenwave's current shareholder agreement. If Greenwave accepts this funding, they'll have to make amendments to their current agreement, which may negatively impact their relationship with Earthwise. Additionally, giving SEV anti-dilution rights can make raising additional rounds of funding in the future more difficult if investors can't obtain their target ownership, or if investors disagree with SEV but can't get rid of them. Now, let's look at William Wise's terms. At a high level, the most significant items are 1. His offer is to lend Greenwave $30 million of convertible debt at an interest rate of 8%, which is convertible at the end of 5 years into 3 million shares. 2. He would expand board members from 5 to 6. And 3. He'll have the right of first refusal if Sarah and Jessica sell their shares in the next 5 years. Now, the pros of accepting William's offer are 1. William has experience in Greenwave's industry and will be an active participant on the board. The fact that he wants the right of first refusal for Sarah and Jessica's shares shows that he's committed to the company's growth and is willing to take on more ownership. 2. His terms are more founder-friendly compared to SEV's, as his doesn't contain anti-dilution terms. This makes it easier for Greenwave to raise additional rounds of capital in the future, and rather than taking Sarah and Jessica's joint appointment, William will expand the board by one. And lastly, 3. Interest payments will provide Greenwave with a roughly $600,000 tax shield, making them better than preferred dividends. Now, the only con associated with William compared to SEV is that he has less resources, as he's only one person and SEV is a venture capital firm.
Now, with all these factors in mind, let's come to a conclusion on which term sheet Sarah and Jessica should proceed with. Ultimately, we do find that William Wise's prior experience, combined with his conviction in the industry and the founder-friendliness of his terms, making a much stronger option compared to Sustainable Edge. Now, we've covered quite a bit these past 15 minutes, so let's wrap up with a key summary. So, on top of the information provided to us, here are a few key assumptions that we operated under. 1, we implemented an illiquidity risk premium of 3% for the ESG consulting division and 4.5% for the ES division. 2, using public market comparables, we use an exit revenue multiple of 1x for the ESG consulting division and 2.5x for the ES division. And 3, this isn't listed, but again, I want to emphasize that we used a different WACC in our expansion scenario by baking in the impact of William Wise's term sheet that we'll be proceeding with to fund the expansion because of the changes to capital structure. Now, our valuation saw the ES expansion give way to a 57% and 760% increase in EV across the 2 divisions respectively. These figures far exceeded Greenwave's WACC, and thus we do advise to proceed with the expansion. And as we just discussed, here are the pros and cons to both term sheets on the table. To wrap up, we ultimately advise Sarah and Jessica to fund the ES expansion through William Wise's Series B funding offer. This is due to his ownership-friendly terms in combination with the industry expertise and experience that he brings to the table. So thank you all again for the opportunity to take on the Greenwave project, and we're confident with our analysis, we can help Sarah and Jessica make the best decision. We'll now open the floor to any questions you may have, and here are also some of our appendixes to give you a more in-depth look at our analysis.
I'll start. Very good presentation. I'm very impressed with the level of details you put into it. And I had a brief review of your Excel, and I did notice you conducted a sensitivity analysis on your conclusions with changes in the rates. So if we can stay here a little bit, I'm very curious. So when you said the exit multiple being 1 times for ESG and 2.5 times for the EAS, so that is a multiple on revenue.
Yes.
So I'm wondering, have you considered what is the exiting multiple on the free cash flow? And would that change your conclusion if you considered the multiples on free cash flow?
Yeah, so I can take that question. So I can first explain as to why we chose the revenue multiple, just because, as Dennis mentioned in our executive summary, kind of wanted to take a more VC-esque lens. And given the fact that this is a Series B raise, all our VCs are more so looking at the growth potential for the company, and we felt that the revenue multiple was more appropriate for it. As to whether or not we did a sensitivity analysis based on a free cash flow multiple, I'll admit that's something that we had not considered, but I would assume that at least within the case of the current operations, it would definitely affect our valuation and would definitely affect our valuation a lot more for the expansion case as well.
Right. So how much room, so if I were the client, how much room do I have? Let's say if my multiple oscillates between 2 times and 3 times, would I still consider proceeding with the investments?
Sorry, so just to reiterate your question. Your question is, if the multiple was it was 2 times, would I can proceed with this investment? I see. Okay. So most likely not based on a 2 times multiple, but given the fact that the current market sentiment is currently trading at 2.5 times as kind of highlighted in our comps, we feel more confident in given the fact that it will be more of a 2.5 times multiple.
Right. Wonderful. Have you guys conducted additional research in coming up with your analysis? And if so, what research have you done, and what sources of information have you looked at?
Yeah, I would say just to start, one of the first external research we considered was just looking at public market comparables. which is where we found out that it was a little harder for us to find very comparable ES firms. Just to give some examples, I would say, I think off the top of my head, Amerisco and Bloom, they service schools, utilities, healthcare, and government, whereas GreenWave is more on commercial industrial. So it was very hard to find, for one, ES companies that are public, but two, ES companies that are publicly available, also very directly comparable.
Great. Just my final question. Maybe I missed it during the presentation. What was your recommendation regarding the IPO?
So we didn't actually I don't think we necessarily stated a decision for the IPO. It was more so we felt like with the exit revenue multiple, we felt that if the company were to decide to go with an IPO at the end of the forecast, that would be the approximate value that they would receive.
Right. So you would recommend the company commence an IPO after the 5-year projection if they meet the forecast.
Based on what we were seeing, they might need additional funding rounds like a Series C or Series D, which is primarily why we did recommend the William Wise term sheet, because if you have, let's say, a sustainable edge who can maintain this 25% equity stake and you have future funding rounds, a lot of these other VC firms are going to be scared off by the fact that they might not be able to get the stake that they want. But the reason we were a little more unconfident on being able to IPO is that we just don't have enough information on the customers that we have right now. So there are different risks as to contract quality, as well as if there's any customer concentration. We need to have a better comprehensive view of who the customers are before we can give a concrete recommendation on whether or not it can IPO.
Wonderful. Thank you very much. I'll leave the questions to other judges. Great job.
Hi, everyone. I've got a question. Firstly, great job, putting together the analysis. It kind of went step by step and it was well organized. Just curious, I see the precedent transactions in your appendix. How did you use them to, or I guess in the work that you did, so on the different valuation approaches, how did you actually consider those precedent transactions in your analysis?
Yeah, so I can take that question. The main thing is that we decided not to move forward with kind of using the precedent transactions, primarily because of the fact that we felt like with these multiples, although they are not as high as the current public markets, there was some sort of control premium embedded into each of these. And so we felt like it wasn't really a good representation as to the value of the company should they IPO compared to if they were to be acquired.
Thank you.
Hi, everyone. Great presentation. I like how you highlight the relevant part as we move through the presentation. I was curious to know if you looked at the financial implications of the term sheets, specifically how the company would have been able to satisfy the dividend requirements, the interest obligations, and each of the term sheets.
Yeah, so in that case, we do have different cash flow statements in our appendix. So the slide that I have open right now, this is the cash flow statement should they go with William Wise, and William Wise doesn't convert his convertible note at the end of the 5 years. And the main takeaway at the bottom here is just the fact that they will generate, if they go with William Wise and he decides not to convert, they'll generate $172 million in cash flow. While we've compared to the conversion case, they will only generate $142 million cash flow. One thing I do want to highlight is that even if we were to go with Sustainable Edge's term sheet, GreenWave will only be able to generate $9 million more than the William Wise case, assuming that he converts. And so the biggest part of that is just the fact that the interest tax shield with the William Wise's convertible note provides a lot of leeway for the company to work with, while the preferred dividends are all coming out of after-tax earnings.
Okay, all right. Thank you.
Okay, thank you for the presentation. With respect to the term sheet you're accepting, would there be any sort of things you'd like to negotiate and why, or how do you think you could achieve a change?
Relatively
Yeah, I could.
speaking, I'll let Ben take it.
I'll briefly touch on it first. So I think the biggest thing with William's term sheet, if we were to change anything, would just be removing his option for us to pay out at the end of 5 years, and rather it automatically will convert into 3 million shares, just so we could have just so we could accurately project our cash flows, and we don't have to predict if we're going to have to pay out that 30 million or not in debt. I think that's the biggest thing we'd want to change. Dennis, let me know if I missed anything.
Yeah, you covered everything I was just about to say.
Okay, I have one other question. I just kind of maybe it's me, it's probably me, but you have a 46.4 million Series A pre-money value on one of the pages. And I'm wondering, maybe I missed it, but how did you arrive at that value? What are the inputs to get there?
Yeah,
maybe
so
there's a page you can point me to.
Yeah, so the main way we solved for the pre-money valuation is that we simply took the Series A investment that was put in, so the 25 million, and then we then divided it by the ownership that Earthwise took. So that was the 25%, which then gave us our post-money valuation. And then after that, we then subtracted the Series A investment of 25 million to get to our 46.4.
Okay. All right. Thank you. That's it.
Great. Thanks so much, Team 28, for this excellent presentation. Judges, head on over to the breakout room for deliberations. I'll see you over there momentarily. And to Team 28, again, excellent job, folks. And be sure to log on to the live stream at 7:30 Eastern to watch the results.
All right. Thanks again for the opportunity.
Thank you so much.
Thank you, everyone.
Thank you.
What's the key to unlocking value in the business world?
For over 50 years, CBV Institute has set the standard for excellence in the business valuation profession. The CBV program of studies continues to be regarded as the gold standard in business valuation education, and our members remain highly respected and in demand throughout Canada and the rest of the world. By setting a high bar for our students, our members, and the business valuation community at large, we ensure the ongoing integrity and authority of the CBV designation. The status quo is never good enough, however. Through thought leadership, ongoing curriculum enhancements, and consultation with global regulators and standard setters, we make sure to stay at the forefront of industry developments and trends, keeping our members and students well positioned for continued leadership in the business valuation profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
The CBV designation is more than just a professional title. It's a gateway to a wealth of opportunities in the finance and business worlds. I'd like to elaborate on 5 of the key benefits that members tell us they enjoy as a result of being a CBV. 1, CBVs enjoy extremely diverse career opportunities. CBVs work in a wide range of areas, including corporate finance, transaction advisory, income tax and estate planning, litigation support, financial reporting, and much more. In short, CBVs are needed wherever and whenever an assessment of value is needed to drive a key business decision. 2, because of our high-quality education and professional standards, CBVs are highly sought after and have in-demand expertise. Demand for CBVs and CBV services has never been higher. CBVs are the go-to professionals when businesses or individuals need to understand value, and their skills are crucial in deal-making, litigation, and many other strategic decisions. 3, the CBV designation is respected worldwide, which opens doors to international opportunities, including working on cross-border projects or working overseas. Now, these 3 points taken together means that CBVs have extraordinary job security, which is extremely important in a constantly evolving economic and technological landscape. There will always be demand for valuation expertise. And of course, there are significant financial benefits to being a CBV. Most newly designated CBVs will enjoy a salary bump, and they often command starting salaries approaching or exceeding 6 figures. But most importantly, our members truly find value and have fun in their work, and they love what they do. They're at the forefront of financial market developments. They are leaders in finance and business, and they are constantly learning and adapting to interesting new challenges. As a CBV, you'll develop the unique ability to see what others might miss in the world of business. You'll uncover hidden value, navigate complex challenges, and make a real impact in organizations across a broad spectrum of industries. If you're ready to join a global community of valuation leaders and take your career to new heights, the CBV designation is your path forward. I invite you to embrace this transformative journey and discover the power of seeing beyond the numbers.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What's the key to unlocking value in the business world?
Becoming a CBV is a journey of personal and professional growth. The path to becoming a CBV is relatively straightforward. First, individuals must complete our globally respected program of studies, which delivers practical and relevant business valuation education. After completing the program of studies, the next milestone is the Membership Qualification Exam, or MQE. The MQE is a case-based 4-hour capstone exam, and it assesses your ability to respond to real-world situations that you may encounter as a practicing CBV. Individuals who pass the MQE are eligible to apply for membership. Before applying for membership, there are 2 more requirements. First, because practical experience is crucial in any profession, we require a minimum of 1,500 hours of business valuation or related experience. Because most individuals are working full-time as they work through the program of studies, they have earned their hours by the time they're ready to write the MQE. Secondly, individuals must have a 4-year degree from a recognized post-secondary institution. This means that university students can start the program of studies when they're still in school, but you do need your degree by the time you apply for membership. While a background or degree in finance or business is helpful as you move through the program of studies, it's not a requirement. Business valuation is a multifaceted profession that calls on a variety of skills and aptitudes, with an inquisitive mindset and excellent communication skills being high on the list. The journey to becoming a CBV is a rigorous path, but one that leads to immense opportunity and a rewarding career.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
Our globally respected CBV program of studies is the cornerstone of the CBV designation. It's designed to deliver practical, relevant business valuation education that places new CBVs at the forefront of business and finance. The program consists of 4 core courses that provide a robust foundation in valuation methodologies and real-world applications. Students also choose 2 out of 4 elective courses, which allows them to specialize in areas such as private investments, litigation support, corporate finance, or valuation for financial reporting, all incredibly important topics. What sets our program apart is its practical, market-driven curriculum. Our content is designed by CBVs for future CBVs, and it undergoes regular updates to reflect current best practices and relevant topics. This means our students are learning directly from industry leaders, and they're gaining knowledge and developing skills that are directly applicable in the workplace. We've built the program to be flexible and accessible. With online, self-paced learning, opportunities to connect with instructors and peers, and courses offered 3 times per year, students can complete the program while working full-time. Plus, all materials and exams are available in both English and French. It's a rigorous program that thoroughly prepares our students to excel as CBVs. Upon completion, they have the in-demand skills and knowledge to succeed in this dynamic, rewarding profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
For over 50 years, CBV Institute has set the standard for excellence in the business valuation profession. The CBV program of studies continues to be regarded as the gold standard in business valuation education, and our members remain highly respected and in demand throughout Canada and the rest of the world. By setting a high bar for our students, our members, and the business valuation community at large, we ensure the ongoing integrity and authority of the CBV designation. The status quo is never good enough, however. Through thought leadership, ongoing curriculum enhancements, and consultation with global regulators and standard setters, we make sure to stay at the forefront of industry developments and trends, keeping our members and students well positioned for continued leadership in the business valuation profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
The CBV designation is more than just a professional title. It's a gateway to a wealth of opportunities in the finance and business worlds. I'd like to elaborate on 5 of the key benefits that members tell us they enjoy as a result of being a CBV. 1. CBVs enjoy extremely diverse career opportunities. CBVs work in a wide range of areas, including corporate finance, transaction advisory, income tax and estate planning, litigation support, financial reporting, and much more. In short, CBVs are needed wherever and whenever an assessment of value is needed to drive a key business decision. 2, because of our high-quality education and professional standards, CBVs are highly sought after and have in-demand expertise. Demand for CBVs and CBV services has never been higher. CBVs are the go-to professionals when businesses or individuals need to understand value, and their skills are crucial in deal-making, litigation, and many other strategic decisions. 3, the CBV designation is respected worldwide, which opens doors to international opportunities, including working on cross-border projects or working overseas. Now, these 3 points taken together means that CBVs have extraordinary job security, which is extremely important in a constantly evolving economic and technological landscape. There will always be demand for valuation expertise. And of course, there are significant financial benefits to being a CBV. Most newly designated CBVs will enjoy a salary bump, and they often command starting salaries approaching or exceeding 6 figures. But most importantly, our members truly find value and have fun in their work, and they love what they do. They're at the forefront of financial and market developments. They are leaders in finance and business, and they are constantly learning and adapting to interesting new challenges. As a CBV, you'll develop the unique ability to see what others might miss in the world of business. You'll uncover hidden value, navigate complex challenges, and make a real impact in organizations across a broad spectrum of industries. If you're ready to join a global community of valuation leaders and take your career to new heights, the CBV designation is your path forward. I invite you to embrace this transformative journey and discover the power of seeing beyond the numbers.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What's the key to unlocking value in the business world?
Becoming a CBV is a journey of personal and professional growth. The path to becoming a CBV is relatively straightforward. First, individuals must complete our globally respected program of studies, which delivers practical and relevant business valuation education. After completing the program of studies, the next milestone is the Membership Qualification Exam, or MQE. The MQE is a case-based 4-hour capstone exam, and it assesses your ability to respond to real-world situations that you may encounter as a practicing CBV. Individuals who pass the MQE are eligible to apply for membership. Before applying for membership, there are 2 more requirements. First, because practical experience is crucial in any profession, we require a minimum of 1,500 hours of business valuation or related experience. Because most individuals are working full-time as they work through the program of studies, they have earned their hours by the time they're ready to write the MQE. Secondly, individuals must have a 4-year degree from a recognized post-secondary institution. This means that university students can start the program of studies when they're still in school, but you do need your degree by the time you apply for membership. While a background or degree in finance or business is helpful as you move through the program of studies, it's not a requirement. Business valuation is a multifaceted profession that calls on a variety of skills and aptitudes, with an inquisitive mindset and excellent communication skills being high on the list. The journey to becoming a CBV is a rigorous path, but one that leads to immense opportunity and a rewarding career.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today. What's the key to unlocking value in the business world?
Our globally respected CBV program of studies is the cornerstone of the CBV designation. It's designed to deliver practical, relevant business valuation education that places new CBVs at the forefront of business and finance. The program consists of 4 core courses that provide a robust foundation in valuation methodologies and real-world applications. Students also choose 2 out of 4 elective courses, which allows them to specialize in areas such as private investments, litigation support, corporate finance, or valuation for financial reporting, all incredibly important topics. What sets our program apart is its practical, market-driven curriculum. Our content is designed by CBVs for future CBVs, and it undergoes regular updates to reflect current best practices and relevant topics. This means our students are learning directly from industry leaders, and they're gaining knowledge and developing skills that are directly applicable in the workplace. We've built the program to be flexible and accessible. With online, self-paced learning, opportunities to connect with instructors and peers, and courses offered 3 times per year, students can complete the program while working full-time. Plus, all materials and exams are available in both English and French. It's a rigorous program that thoroughly prepares our students to excel as CBVs. Upon completion, they have the in-demand skills and knowledge to succeed in this dynamic, rewarding profession.
So what's the key to unlocking value in the business world? It's the expertise, integrity, and insights of chartered business valuators. Join us in shaping the future of business valuation. Become a CBV today.
Good evening, everyone. We will get started with our presentation in 2 minutes. Hang tight.
Good afternoon and good evening, everyone. It's the moment we have all been waiting for today. Welcome to the closing remarks and award ceremony for CBV Institute's 2024 Business Valuation Challenge. My name is Dr. Christine Sawchuk, and I am the President and CEO of CBV Institute. It is my pleasure to welcome you here today. We are in our third year of this case competition, and in each year we've witnessed growth in the number and participation of undergraduate students from business school teams across Canada. This year, we had 30 teams and 109 students register for BV Challenge. On behalf of CBV Institute and our network of business valuation professionals, I would like to once again congratulate this year's participants. We've received numerous comments throughout the day yesterday and today from members and other people that were very much impressed with your presentations and the extent of your analysis. So the caliber of your professional presence and your calculations and analysis very much impressed the judges and everyone watching the case competition. In particular, congratulations go to the 6 teams who proceeded to today's final round. This year, our awards will be announced by one of our title sponsors. I am pleased to hand things over to Vince Razzo, who will be speaking on behalf of KPMG. Vince is a partner in KPMG's deal advisory practice and has broad experience in business valuation, corporate finance transactions, and related advisory work. He has over 15 years of professional experience at KPMG. Vince specializes in business and intellectual property valuations, with a particular focus on the valuation of pension and private equity investments. He has a range of experience that I won't get into today because we're all waiting for the results. Vince formerly served as a member of the examination committee of the Chartered Business Valuators Institute, and he was a part-time lecturer in the Faculty of Business at McMaster University. Over to you, Vince.
Thanks so much, Christine. Just before I get into the results, just want to quickly say, in talking to a few judges, just want to reiterate Christine's comments in terms of how excellent the presentations were. And I know it was a very difficult decision for the judges to narrow their results. But without further ado, it's my great pleasure to announce first, second, and third place winners for the BV Challenge 2024. Just quickly by way of reminder, the third, second, and first place teams will receive $2,500, $5,000, and $10,000 respectively. So without further ado, in third place from the University of Waterloo, we have Daniela DeJoma, Xavier Tony, Vanny Tran, and John Young. Congratulations on your third place finish. In second place, we have Connor Kindrate, Tyler Olson, Jackson Price, Natasha Savliana, representing Okanagan College, pardon me. Congratulations on your excellent results. And finally, without further ado, the winner of the BV Challenge 2024 is Muskan Agrawal, Sabrina Choi, Cedric Furman, and Caitlin Zhang, representing the University of Toronto St. George campus. Congratulations on winning this year's BV Challenge, and congratulations again to all the teams who participated. Back to you, Christine.
Thank you, Vince. On behalf of CBV Institute, congratulations to our top teams from Waterloo, U of T, and Okanagan College. A quick note to our top three teams before we finish, if you're still listening in. A member of the BV Challenge team will be in touch via email over the next 24 hours to discuss next steps. And now we close the door on BV Challenge 2024. Thank you so much to all the schools, or to the students representing business schools from across Canada who accepted our challenge, our esteemed panel of judges who volunteered their time and expertise, and last but not least, our sponsors who stepped up to support our third annual business valuation case competition. All of your collective efforts and dedication have significantly exceeded our expectations, and we're already looking forward to BV Challenge 2025. We hope to see you there. Thank you, everyone, and have a great evening.